I took that mid six-figure lump of cash and tripled it into the top in 2000. You start running $200-300 million and you've got a lot of people depending on you. That's a lot of added pressure.
This is Jim Roppel, a hedge fund manager that trades over $200 million. He learned directly from a market wizard, but before all of that, he blew up his account 3 times.
I have made every single mistake that is makeable in the stock market. My wife is like, Jim, look at our tax returns. She's like, go to law school. I don't know what she said. She said, stop doing what you're doing. Price will hurt you, but size will kill you.
How long did it take you to actually go and get profitability, I would say, and really make meaningful progress in your account?
I think it took about 5 years. When you have life-changing money, and whether that is from bicycle to automobile or your 1-bedroom house to a 5-bedroom house, whatever, you have to take it. Broadcom had the chip. It was the first stock I made $1 million in one trade. That probably doubled my war chest. This is how you handle a real TML, and the answer is earnings season is like the minefield that can give you the golden fruit. You can get obliterated or you can find gold.
Is there a conversation you had with Bill or something he said to you you remember every single day?
Well, there's dozens, but one that kind of stung.
Hey everyone, welcome back to another episode. As always, we bring top traders, US investing champions, and market wizards here onto the show to share their journeys, their strategies, the mistakes they made throughout their careers, and key learnings that they want to pass on to you guys to save you time, save you money, and improve your performance. We've been lucky enough to hear back from many viewers over the past few years about how much of a positive impact this podcast has had on their trading journeys, and we're incredibly grateful for all the support. If you're looking for a free, quick, and easy way to give back to us and show us some goodwill, please double check that you're subscribed down below. And if you aren't, go ahead and click that button. And with that said, thanks again for your support, and sit back, relax, and enjoy. All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moglen. This episode is brought to you by DeepView Charts. Check out the link in the description for a special offer, and also check out the new DeepView AI. Joining us today on the podcast is Jim Roppel, hedge fund manager and growth stock trading legend. There he is, right over there. This is so cool because this is one of the first in-person ones I'm doing, and you were one of the very first guests I've ever interviewed. And I've learned a ton from you, earnings gaps, finding leaders, and today we're going to dive even deeper into your strategy. And crucially, I'm going to pick your brain, get all the secrets for how you find and manage life-changing trades, taking you from first class to private jet.
Come on.
Cool. So if that was on your bingo card, your Jim Roppel bingo card, there you go. But first, for folks who don't know you, Jim, maybe this is the first time they're seeing a podcast with you. How did you first kind of get started in this business? Now, of course, you're managing capital, but how did you first get introduced to trading in the market?
You won't believe this, but my grandfather was a Russian immigrant, and he worked I'm in Chicago, and he worked in the Bally pinball machine stamping factory, stamping deck boards. And he got Bally stock options. This is like 50 years ago, more. And we would watch Bally stock when I'd go to my grandpa's house on Sunday. And then my dad, because of the Bally, watched the market. And then my dad inherited a little bit of money from his father-in-law, and he bought Genentech. We're going back 50 years ago. And he was dabbling in the markets. I go to college, and my roommate's father was a stockbroker. And then who ended up becoming my best friend in college, inherited a lot of Paramount stock from his grandfather. So we watched Paramount. And then because I was a slow learner, I was a 4.5-year grad. I graduated in December of '87, right after the crash. And I mean, leading into the crash, I was buying put options because the market looked bad. I didn't know anything at all. I thought it looked bad, but we were buying Chrysler put options and put options on Paramount. So my friends, my family was just kind of always around me. And I remember taking like $300 out of my checking account in college, putting it into an A.G. Edwards brokerage account and buying like one call option at a time. And then I graduated in December '87. And I went on my very first interview to a penny stock operation, and they hired me on the spot. Of course, they'd hire anybody who had a heartbeat. And I cold called my way into a job at then my dad's broker hired me at David A. Noyes, a local boutique firm in Chicago. And I worked there until I got recruited. I went to work for Northern Trust in Lake Forest, Illinois, where all the big bucks people are, which funded. Yep. I was a cold call stock jockey.
Yep.
And then Morgan recruited me. and they paid me a forward sum of money in 99, and I took that mid six figure lump of cash and tripled it into the top in 2000. And I was so funny. I think I had like 13 climax runs in my account, and before St. Patrick, I went to complete cash in 2000, right around St. Patrick's Day, because I remember my wife's like, "You've been working like crazy forever, and let's take the kids and go to Arizona." So we just bolted off to Arizona. That's how I know the timing of it. How's that? Pretty good?
That's perfect. That's perfect. And for anybody who knows you, your style is can slim. You've learned a ton from O'Neill, that methodology. I want to ask, what was the first time, what was the first time you got exposed to can slim, that way of trading, and also your first time like seeing Bill? And obviously you guys became closer later on, but I'd love to hear kind of how it got started for you and how that kind of style appealed to you.
Okay, so you understand, I had no help, no guidance back in the day. Like, you were a cold call dude. Like, you just picked the stock. Like, you had nobody teaching you about how to select stock or portfolio management. And I stumbled onto the paper at a 7-Eleven, and I saw the top of a copier box. I would take the lid off, and I'd cut all the mini charts out, and I'd tape them in there. And I found that the same stocks over and over, I would line, they keep going. I'm like, oh my God, this. And then I found there was a book, and then I read the book. And then
What version was that? What color copy? Or you've got it right here.
hardcover, bro, old school. I mean, this thing is a dino. I'm looking at how young Bill looks on the cover.
Yep.
But oops, sorry.
You're good. You're good.
And I started to. So there's a paper depot in my little town that I live in, and I would drive there at midnight to get the next day's paper, and I would read it in the parking lot till 1 a.m. So I'd already read the paper before he went to bed, and then I'd go to bed at 1. In the office, at 8 before the open. And, I was a loser back then. I would like get a money magazine and read an article. I was doing what my dad did, which was big in biotech. And there was a big biotech cycle right when I got started. So it worked great. And I didn't understand that cycles didn't go on in perpetuity. And so they all blew up. And I read the book and I started to cut my losses.
And was that a turning point for
massive, gargantuan? Because everybody picks some good ones, but everybody picks some bad ones. And if you don't take care of that, you can't make any progress. It was a defining moment because I just didn't draw down from a cash position. And then I started to use better selection criteria. And it just was like a miracle. I mean, I went from a complete loser to I started to make better mistakes.
Right.
And that was the genesis of it all. But I literally owe everything to Can Slim, and specifically to Bill, who, like, he really paid attention to me, even when I was just like a guy going to his little classes, which were game changers. And I started to go, I think I went to my first class with Bill in like 94-ish. I can't really remember, but I went to see him at 2 to 3 times a year, every single year, for like 20, 30 years. So I paid to go see Bill 60, 80, 90 times. And then I became an institutional customer when I opened my first hedge fund in 2004. And part of the deal was I had to have 4 or 5 calls a year with Bill. And he would call me. Well, before that, I would have bad trades. Yep. And I'd talk to him. He'd be like, okay, print a chart and mark it up, why you bought it, where you sold it. And I'd FedEx it to him. He would mark them all up. And I have these. They're, to me, like gold. And he would send them, and we'd have a call and say, this is where you screwed it up, kid. And I even have specifically these handwritten notes on Shakeout +3 with Apple Computer that I sold in after hours on a gap down that it turned around and went to Mars. I just, off the tangent, I have made every single mistake that is makeable in the stock market. From every single one, from not cutting losses to over margining, over concentrating, over speculating, over trading. I've made them all. Richard was asking me, what, you called me some superlative. I'm like, I don't deserve it. I make all the mistakes like everybody else. But when you make a lot of them and you stick with it, you learn and you learn. I said to him, I still make mistakes, but I think because I've learned so many of them, I correct them faster. I can recognize that, you know what, I'm over my skis, I'm too big, or I whatever I've done, I correct them quicker. I don't tolerate losses at all, if possible.
Yeah. Obviously, you just said the cutting losses was a key defining moment for you. Were there any similarly, game-changing realizations you had? Maybe it was from attending a seminar with Bill, or just something you developed on your own, a mistake that you fixed that you're like, okay, I'm seeing the market completely different now because I'm recognizing this is something I do every single time. And if I just don't do that, then my results can be, much, much improved.
I think I had no money management. Like I sometimes would end up with my whole account or half the whole account on margin. And back then it was triple leverage.
Right.
I'd end up way too big. And my next door neighbor was a SIBO or a Chicago stock exchange specialist. And he said, I told him one time I had like 25,000 shares of Siebel Systems. This was so long ago. He goes, Jim, he goes, I don't know how much money you have. He goes, but that sounds like a monster position. He goes, price will hurt you, but size will kill you. And then later in the master's class, they kind of had a breakout session where it was, you buy 4 stocks and whatever. And I learned a lot better how to allocate. And also by talking to Bill would say, well, why is that fiber optic stock better than this one? Because there's 8 of them in the sector. And then I started to recognize that there was more than a group move, that the leader in the group move is going to double the performance of the second best.
Right.
And then I think Charles Harris, I was talking to him and he goes, I said, what's the number one indicator? He goes, relative strength is absolutely the leading indicator. And that's, again, an oversimplification. But when I started to write the Roppel report, I select the stocks by RS, like the first, and my performance has even improved in the last 3-4 years because I write down and I give the ideas like that.
Right.
I also learned, when you don't make any money and you think the stock market is the way to get rich, when you start to realize what the power is of a stock that literally doubles or triples, you go from, I want to learn and I'm not sure, to, wow, this really, really works. Like, they say fake it until you make it. Well, when you start, I believed in Bill because I didn't really know if I believed in myself. But when you start to get some successes, little traction, you start to get confidence. And that is an absolute game changer because now this method works.
And in that time where you're kind of building that confidence for yourself, were you profitable yet? And how long did it take for you to go from, bigger losses, you're cutting losses, but maybe still things aren't quite working? How long did it take you to actually go and get profitability, I would say, and really make meaningful progress in your account?
I think it took about 5 years.
Yep.
Because I didn't find Bill in the book, in the paper, for a couple of years. And then it took a couple of years of screwing up.
Yep.
And I'll never forget, my wife is like, Jim, look at our tax returns. You've got to, she's like, go to law school, she said, stop. I don't know what she said. She said, stop doing what you're doing. And she's like, look at our tax returns. We are not making, and I took that as a throwdown. Like, don't ever tell me no, because I just like tripled down to effort. There, John Boyd plug. It's all in here.
Yeah. And now that's perfect, because I was about to ask you, what are some books that maybe you didn't have then? Because, John wrote that a little bit later, of course. But what are some books that really made a difference for you, or now you would kind of recommend to, friends or, someone close to you who's like, how do I learn how to trade? This is the curriculum, the reading list that you would subscribe, assign them to read.
The number one book to see if this is even for you, or if you want to understand the concept, is Darvis's book, How I Made $2 Million, because you can read it in a day. You can read it in 2 days, and it's a story. It's kind of entertaining to read. It's not a textbook, and it really gives you about 50% of what's in the Bible.
Yep.
But then after you knock that down and you commit like this, now you realize, hey, this method agrees with my personality.
Yep.
The Mac Daddy is Reminiscences. Because now when I read this book, I'll never forget, I was waiting for my wife to come pick me up on like our third date. I was sitting on the couch and I was like, wow, this is way I just didn't have enough experience in the markets, like when he would talk about trends and how a stock should act. I didn't have enough money. I had not enough experience. But in this book, I've probably read this book 10 times. If you read it and then you read it again a year later and you've been trading that for that year, you're going to go, wow, you're going to understand it better. Reminiscences is a detailed book of market tactics that you will only understand after you've been in it and in the market. And then now when I read it again, I should probably read it soon. I'll remember, wow, that's so true. This is a never ending process. I'm better right now than I was 3 years ago.
Right.
And I'm certainly better than I was 40 years ago. Like, to be brutally honest, I blew up my account to 0 3 times. I didn't learn like Pavlov's dog. I touched that burner over and over again. But I can draw down from highs because I'm such a bull, but I don't draw down from cost. I just don't. If you draw down from highs, that's not fun, but you're in the game.
Right.
It's when you draw down from cost is when you get into trouble.
Right. And speaking of, mistakes, drawdowns, all that, and speaking of Darvis, I was lucky enough, that was the first book I ever read on the market because Dr. Wish's class, that was the first one. He's like, read this one. And to echo what you said, it's a story. You can read it in a night. And he makes every mistake, he shows his progression, going too much into fundamentals, not pairing that with technicals, every mistake you can make, he shows in a story, and it's a super fun read. So if you ever read that.
Fun. Yeah. Is yourself. It's emotion. When you're not watching, when you're traveling the world, and you're getting telegrams, you're not watching the jiggles and the wiggles.
And then when he went closer to New York, he had a huge setback.
Who else did that? Livermore.
Yeah.
He went to New York and he came unhinged.
Yep.
We are our worst enemy. Look, everybody has access to all these books.
Yep.
Okay. This is one of my prides. I had a good year a couple of years ago, and John Boyk says you should reward yourself. So this is tape reading by how to trade in stocks. This is an original copy, and I have to go big shout out to my man John Boyk.
Yep.
But what was I saying about emotions? Oh, these books have all the rules. They're right here. There's no secrets. There's a few, but if you just read these 5 books, that you don't need to read any other books. Maybe one on psychology, but they're all there, and most people can't make money because it's them.
Yep.
They think it's like it's the pivot point or the chart or the whatever. That's not it. It's up here. It's like golf.
Yep.
The inches between here and here is the big struggle. That's where it's emotion. Emotion is what breaks down possible great traders.
Yep. And you talked about confidence and like how you weren't confident in yourself yet, but you were confident in Bill and his process. And then you proved it to yourself with your own trading. And over time, that's how it goes.
There's a lot of imposter syndrome up front. But after, say, 10 years or something, through several bear and bull phases, you're like, it can't be a fluke. But initially, the first couple, and then when you give money back, you're not sure. But after maybe 10 years, you can, if you have consistency, which I didn't initially, you could start to say, well, there's more to it. It's not a fluke.
Yep. And just to point out the last book, Market Wizards, tell me about that one.
Okay, they're all phenomenal. But I have articles going back. This is an article with Richard Driehaus. I have cases of model books, O'Neill model books. When you go to 20, 30, 40, 60, 80 O'Neill presentations, you have all these model books. And I just have all this material I should start posting it on Twitter. When I post that on Twitter, the likes go through the roof. Nobody gives a crap about what I say. But when they see those old articles, they love that stuff.
Yeah. And we might have to fill a few of those and show them to folks.
That can do that.
Cool. For people who aren't super familiar, how would you describe your personal style now? Obviously, it's can slim position trading. How do you describe your objectives in the market, what you're trying to do in maybe just a few sentences, if you can keep it to that short of the answer?
Well, I'm certainly not the person I used to be. I'm 61. I started when I was 21. Oh, no, in college I started in, like 85. But I was a highly leveraged, frenetic overtrader. I have settled down a great deal. Like, I think I probably enter maybe 25 stocks a year. That can vary, but I don't take the risks I used to. I just don't. I would say to anybody, you don't have to run in sprints. You're going to fall way harder. If you just jogged along, you probably would live longer. I didn't, my mom was like, Jim, this pressure is breaking you down. I was a kid and I said, oh, it's nothing. And as I age, I recognize this is real pressure. And when you start running other people's money and it starts to get big, you start running $200-300 million. And you've got a lot of people depending on you, and you know that you're going to get calls. That's a lot of added pressure. So my point is, how did I change? I think the evolution of a trader is less trading, and longer duration, and taxes matter a great deal when they, 20% short-term or long-term versus short-term is really big. And the formula, the 4 to 6 beat and raise quarters takes you past the cycle time, position size, experience, and a $5 million account. I know, like the big boy category in the U.S. investing championship is $1 million. You can buy $1 million worth of about any stock just by hitting enter. Now, you want to go buy 20, 30, $40 million worth of stock? Now you are really precluded into highly liquid names. And through that, you learn about liquidity. Most people have no idea how critical liquidity is, because if you don't have institutions, you don't have liquidity.
And they need liquidity.
They have got to have it. Now, when you get liquidity, now you're in stocks that are going to be generally held, a good base of shareholders. So when somebody goes to blow out 100,000 or $1 million, there's buyers there. Now there's a couple little stocks we talked about, like AAOI and Fastly. You go to sell 500,000 shares of that, you're going to realize, wow, liquidity really matters. But if you have a $5 million account, you're buying 2,000 shares or that's that doesn't factor. So
to bring you back to the original question,
which is,
how would you describe your trading style in 2 sentences? Give me 2 sentences there.
I'm an intermediate term trend trader I like to say high growth stocks, but in the current market we're in at this minute, it's been a split tape. And energy stocks, commodity stocks may down the road have big earnings, but they don't initially. We're in a different type of tape, which does not suit me that well. I love the tech. And so I'm an intermediate term trend trader. Based in, and like, I miss SanDisk because I didn't miss it. It didn't have earnings initially, and I balked at it. And we talked about that today. I really, really am pretty rigorous in all the criteria. I remember 30 years ago, Bill put up a chart at eBay, and he went through every variable and say there's 30 on a data graph. It had 29. And every time you sacrifice one variable, your probability of success goes down. And I also, you said, what did I learn? Triple digit sales and earnings are it's part of the magic elixir, which is sky high liquidity with sky high earnings. Now if you find the highest earnings growth stock with commensurate volume, every institution's gonna be there. The big guys, they have to be. Like Janus 30, they're putting 500, they're putting $1 billion, $2 billion in each stock. So they've got to have max liquidity. So they go down, they get the liquidity scale, and they go, what's got the highest earnings, until they get to a zone, and that's where they hone in on.
No, that's perfect. And you kept it to at least 10 sentences. So that's pretty good, Jim.
Dude, I didn't take it into like a segue into like a camera stuff.
No, Hey everyone, just want to jump in here real quick and let you know that this episode is brought to you by DFU, which is the platform I use every single day to find new trading ideas, monitor existing positions, identify new leading themes, and analyze the markets. You guys deserve a platform that keeps innovating and brings you the most up-to-date tools to trade the market. And at DFU, almost every single week, we're launching a new feature or system update. Here's what makes DFU different. The screener comes loaded with preset screens from actual market wizards and top traders. So you're starting from the setups that the best in the world actually use. And when you're flipping through results, you've got mini charts right there, so you can visually scan through hundreds of stocks all at once. That alone saves me so much time every single week. The charting is built for how we actually trade. Multiple timeframes, unlimited indicators included anchor VWAP, enhanced volume, custom indicators like RMV, and the built-in RS rating. You've got custom dashboards to track the market, themes, and real-time sector rotation, so you always know where the money's flowing. Best yet, we just launched the DeepView AI terminal, which brings all your research into DeepView with easy-to-use preset prompts or your own custom ones. You can even identify gap catalysts with just a right click. We set up an exclusive offer of 1 free month for all TraderLion podcast listeners. So to activate your trial today, check out the link down below in the description or visit deepview.com/podcast. That's deepview.com/podcast. And with that, let's get back to the interview.
Perfect. It's perfect. I want to talk finding these stocks, finding these market leaders.
Yeah.
And, Bill called them model book stocks. We can call them whatever we want, right? But what for you is the criteria? What are you just talk triple digit earnings or sales. That's definitely a part of it. But for you, what is the type of stock that you're looking for that you want to buy and hold for ideally months, ideally years, right? So what is a market leader? How would you define it?
So it used to be a lot easier to find them because we'd have chart books and I'd go through every page and I could see when stocks would be turning up, like they didn't have the RS yet, but I could see the group was maturing. So now you screen for super high RS. Well, they only come into light later when you're screening. But I'm looking for stocks really, dude, it's a perfect can slim template. I have it in WANDA. One's called 2020, one's called 40/40. Pre-tax, after-tax, ROE, sales growth, earnings beat, earnings estimates, up to down volume, group strength sky high, all above 20. Not RS. RS I want in the high 90s.
A 12-month RS or different?
Whatever's, Webster programmed WANDA for Bill.
Yep.
So whatever's in WANDA is what works for me. Okay, I don't monkey around. If Bill wanted yearly or shorter term, it'd be in there.
Yep.
I think it's a weighted RS.
To shorter time frames.
I believe so. And RS, it's terrible on the way down. It's misleading completely. On the way up, it's legit. But on the top, it can stay very high and be 50% off the high.
Yeah.
So I run the 2020 screen. If you find a stock that has 20% of across all variables, you're in. There's probably 5 in the whole market. And that's all you need to care about.
Yep.
When I would talk to Bill, he had 3 stocks he wanted to talk about. That was it. Nothing else mattered. He was invariably, the names we would talk about were triple digit sales and earnings. He would sacrifice RS a little bit where I don't as much now. Am I off track?
You're good. This is gold. Promise.
Okay. I'm looking for new highs. I want no overhead. I want pristine. I want the one elite leader. And again, a lot of times I'm going to get into a stock where if I wasn't in it years before, I probably don't know the fundamentals. Another guy who helped me out a lot was Lee Freestone.
Mm-hmm.
When you called the paper 30 years ago and you had they'd send you to Lee, and I got close with Lee, and I had lunch with him one day, and I'm like, "What'd you do?" He's like, "I just bought a couple 100,000 shares of DoubleClick." I'm like, "What do they do?" He's like, "I'm really not sure. I'll figure it out tonight." And so I find myself buying stocks a lot on price action.
Yep. That gets your attention. That's how you find them. Yeah.
Probably my best screen, which I was trying to run today, is up on volume.
Right.
And then I sort it by minimum liquidity of 100 million a day. I'll take it down to 50.
Yep.
Sometimes, but I'm looking for big standout price action pre-tape in the morning. I'll wake up and pop on CNBC. The best interviews, by the way, are in the morning. After the open, there's nobody worth listening to really on there. But I want to see that tape. If something's gapping in the pre-market, whether it's a new drug or a clinical trial or earnings, I'm going right to that, and I want to know exactly what's going on there. Outside of that, CNBC is worth nearly nothing to me.
Yep. Okay. So that's for market leaders for you. Obviously, Bill's studies is the average, run can be 18 months. And they can double, triple, hopefully a whole lot more than that. Cisco, there's amazing stories going back in history. And you mentioned what some institutional funds that you're tracking, the Janus 30 and all this. What is going on behind the scenes that creates a monster move like that? Like, what is going on with the funds? What are they? Where are they adding? Where are they selling? All this stuff. Bring us behind the reason why these market leaders can make these huge moves.
Well, there's difference types of leaders. There are leaders that lead for 30, 60 days. Like I thought quantum stocks were just junk.
Yep.
And you can tell by the quality of the margins, generally, if it's going to have durability. I'm looking for stocks that are going to go for over a year.
Yep.
Institutions, most of these, like Fidelity, they're really the big dog. They're trying to buy a stock for 5 years.
Yep.
So when the best thing you can see is when the quarterly filing comes out that one of the funds took a position.
Yep.
Because then you know that analyst in the Fidelity complex is going to go see each fund manager and they're going to go, what's your favorite? And they're generally going to build across different funds and they're going to build it for, a long time, months. That is, but I'll tell you something else. You said I'm going backwards a little bit. What did I learn? When you build a 15, 20% position and you try to hold it for 6 beat and raise quarters, you're now opening yourself up into 4 to 5 pullbacks per year to the 50-day and below, which is often 30% off the high, right? Which is incredibly, what you learn when you try to do that is sitting through that pullback, especially the first one, sitting through a whole new base is very, 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 very difficult. If you're not trimming or hedging, it gets to almost be impossible, especially when you're on margin. And the thing is, your baby is going to be the hot group. And you think, well, I have an auto stock, I have a Tesla, and I have a software stock, and I have a semi. They're different. Well, they're not. They're all growth stocks. And when growth goes, when one growth leader misses, that one might go down 20% that day, but all your others are going down 5%.
Yep.
And if you're on margin, you're looking at a monster down day.
Yep.
So as you evolve, you kind of learn when things get really extended, you have to trim it or hedge it. And I got mixed answers from Bill on this because initially I asked him a million years ago. He said, oh no, I hold it. And later he's like, you have to trim it. So Bill adapted a lot.
Yep. Is there anything, I want to ask you this, has your definition of a market leader, have you adapted that at all in the last 5 years, 10 years, given the new ones that have, happened in the recent market cycles?
I really think I reach for higher liquidity names like larger market caps, but like A-Lab and APP and even to a lesser extent BE, I think the sweet spot for market cap is the dead low of mid. You're out of small cap, like just into mid cap, like the $12 billion market cap that trades, that's liquid. That's, if you can catch a small mid cap that gets to small big cap, fire up the jet, baby.
Yep.
I mean, that's the ones below that. Recent IPOs are generally junk. They're lower quality. They don't have earnings. They'll never have most stocks that come public with no earnings never have earnings. Most stocks that come public undercut syndicate bid or first day close within a year, like 90+%. The odds are terrible. Now what's funny is the really high quality IPOs, I've caught them because they meet all the other criteria.
Right.
I just segued into something. I don't know. What'd you ask me?
No, I forgot. You got it. No, this is what it was. Have you changed the criteria you look for? It sounds like higher quality. What liquidity are you looking for? Obviously, you run a very large fund, so your requirements might be different than a smaller trader. But what are you looking for in terms of liquidity and also that quality factor that you're looking?
It just has to trade $1 billion worth average daily. Now, if I catch them really, really early, it might have just evolved out of 300, 400, 500 million, and the volume explosion, the personality
volume. Yep.
It has a personality change in volume. I'm just looking for higher quality. When you start to get, retail has lower margins by the nature of the industry, but when you get into 20, 30% pre-tax margins and return on equity, you're now dealing with a quality name, especially when you have a market cap that is in the 10 billion to 15 billion zone.
Mm-hmm.
Now, occasionally you'll get a monster grower at 30 billion. You'll get it there. And I'm not afraid of NVIDIA.
Yep. It's liquid. So liquid.
Dude, we bought some stock today. I bought a block of stock and it just I don't think it moved, but we didn't even look. It didn't even move a penny as far as I know.
Yep. And And Tesla was like that too when it was moving. It's just the most liquid thing in the world. And institutions love that, right? Because they're confident in their ability to get in and get out if they need to, and that's huge.
Tesla is, even to this day, an institutional darling. Now, the earnings aren't there.
Yep.
And we can talk about that later, but here's what I learned. I am raging bullish on the future. I think we are about to enter the best markets the world's ever seen, because the innovation is better than the world's ever seen. It just goes to, stand to prove that we see that. But Tesla, the market doesn't believe it right now.
Yep.
I'm wrong. I don't own it in the fund, but over 500, wild horses couldn't keep me from owning that thing. That would be the market signaling that now the market believes what I believe. We need to believe together.
Right. Your thesis, whatever you think about the company, the price action has to match. Otherwise, you're not interested.
If the technicals don't match what I believe to be the fundamentals, it's a no-go zone. Right. I absolutely look. You said, what else am I looking for? If a stock is going to go from 50 to 500, it absolutely, positively has to make a new high all the way. So when I talked about that lid of the paper copier box thing, those names, they just stacked up on top of each other all the way.
Yep.
It can't go from 50 to 500 without making a new high. So the new high list is the gold bar list.
Yep.
Now you throw in liquidity with a 99 comp, and you're looking at one of the elite leaders, and God forbid it has triple-digit sales and earnings.
Yep.
You might be looking at the best stock of the year.
Right. And let's say a name pops up you're up on volume, and it's crazy price action. It's an IPO in the last 3-5 years that's setting up for a potential, looks like on the chart, like a big weekly move. What are you doing to dive deeper into the story and to build conviction? What could you see in the story, the CEO, what's going on that would say, okay, I really need to focus on this name?
I love it when I get a CEO who I was with in decades past, where he went to a new company. The CEO has had success with other companies.
Yeah.
So I have great leadership. That really, really matters. Frank Langone, he's like, the first thing I do, well, first of all, he holds stocks for 40 years and 50 years.
Yeah.
He goes, I get intimate with these guys. I know everything they're thinking. But dude, I'm so basic. I literally just go on the web and I look for interviews with the CEO. I get a lot of institutional research. IBD, dude, you just search for anything. They cover most of the leaders. There's so much on the web right now. It used to be like, people would be like, well, I can't succeed. I can't get an education. I can't afford an education. There's more info on the web than you can get at any Ivy League school.
Yep.
And by the way, finance degrees, CFA, you do not need that. One of the biggest traders in Chicago worked for a major bank. He literally used a newspaper graph with a ruler and a pencil. That was it. Yep. And he traded grains, S&Ps, euros. Don't get confused. You have to understand the fundamentals, but you don't have to be able to crawl and break down that balance sheet. That's a ridiculous waste of time.
Yep. One question I did have, and this is a callback to kind of what you said at the very beginning, is when you notice a theme like MU and SNDK together, like semiconductor hardware, how do you find which one is the leader? Which one? Obviously, you might build a position in both, with that, which I'm sure you do. But how do you know which one to prioritize? Which one takes more of your capital? How do you judge that potential and compare two very similar stocks, maybe both technically and even in their story? How do you find which one makes the most sense?
The leader is usually going to be the one that breaks out first. And if it's not, the leader often will ellipse the performance of the others fairly quickly. Now, the conundrum occurs when the stock that's not performing as well as the number one price performer has the better ROE and margins. And then you've got to understand, what product differential is it that usurps them or makes them better than the next one? And the problem is, a lot of these technology companies are over my head. Like I can't break down a multiplexer, and I don't understand the formulas. And I actually have some partners in my fund who are like literal rocket scientists, and they're trying to explain this to me. I'm like, just stop. I have no clue. I have a basic clue. What I do at that point is I try to go, what's the total addressable market? Like, how big could this be?
Right.
What percentage is tapped and what percentage do they have?
Right.
And I try to use a little artist matrix of the combination of all of them. Is it performance RS with the variable, the technical variables, the fundamental variables?
Right.
And you like SanDisk was clearly the leader, but it didn't have the fundamentals on the table when it came out. And that's so aggravating to me. But here's the thing. I pretty much missed SanDisk. Eve caught it in what probably her biggest trade ever. She runs my small fund. You don't have to, because the golden goose of capitalism is just going to keep throwing these fastball, golden flaming fireballs of virtue at us. It's never going to stop. Actually, you know what I wanted to do was I wanted to search for a capitalism barometer, like around the world, to see like I think somebody asked me, when is capitalism going to stop? Well, I think it's going to stop never, as long as socialism doesn't suffocate it. But I wish there was a world barometer that said the world is creeping socialism or creeping capitalism. I'd love to know that. Come on, send that in to me. Let's talk.
And you hit another of the Jim Roppel bingo card, the golden goose of capitalism already. So you're doing well. You're on pace. Okay, let's take it a step further. Say you've identified a potential leader. It's looking good on the chart, and looking set up to go. What is the technical setup that you would prefer? That you would say, okay, I need to put shares on here. It's already on your radar. You've looked into the story a little bit. Maybe just the price action is superior. What is your go-to setup to trade these?
Okay, ideally, we're possibly going to get one right now. If this market rolls over, because of some conditions I'm seeing, I think this could turn into a little deeper where we might get cup and handles. So when you get a mini bear, the rubber band gets stretched. Okay, the deeper the bear or the downtrend, the more that gets stretched. And when that thing comes back, that energy gets released. So generally, I want to be screening for these top variables. So I know the names. And when it's running up the right side of the cup and we're maybe ending a bear, or the bear is now gone sideways to stop going down, the AD rating on the index will be going up while the market's still going sideways. I want to buy immediately after a bear market. There's no better chance than that. And I don't think we're going to have a bear market, but we could have a meaningful pullback,
right?
So I want to buy off the biggest pullbacks when I want to get involved.
Yep.
And then cups and handles are people get so cranky when we're in bear markets, and it sucks.
Yep.
No fun, but you're like, well, I know exactly what comes along next. I mean, Lion of Wall Street is one of my favorite books by Dreyfus. A lot of these books, I start reading them and I have to put them down because I get so excited. When you get a bear market, when you start reading a book, you now know, well, when you have history, you know what's coming.
Right.
So when the cup is forming and then the handle forms and it just gets super tight and it has the trip, like APP, that was in the Roppel report every week for 3-4 months or 2 or 3 months before it came out. It had everything and it was handling. And then it just raged out. So you want all the variables and you want a bear market. And generally you just don't get flat bases out of bears.
Yep.
You get cups.
So I love how you just said, I asked, what is your favorite technical setup? And for you, the market is almost the perfect setup because you need that bear market to set everything up, again, stretch that band. And then from that comes the strongest moves. So basically corrections create these amazing opportunities, and we just have to be patient, wait for the market to set up how we need to. And that creates that great opportunity.
It compresses energy.
Yep.
And then when the basketball now here's the thing, basketballs underwater will often, the name that you're all over,
yep,
it'll pop up before the follow through day.
Right.
Like, oh my God, I can't remember the name. I'm getting so old. But like, if you get a name that has triple-digit sales and earnings and the market's been bottoming but hasn't followed through yet, and it hops out, and then the market follows through 2 or 3 days later, this is risky and it's way aggressive, and you're probably down a little bit for the year. So you're probably going to miss it and pass on it because you're like, well, the market's down, or it's not. We haven't had a follow-through day yet, or MMT, market timing, and Dr. Wish's thing isn't green, and point and figure isn't gone positive yet. You might be reluctant, but that basketball underwater, it's going to be the one. Second best chart is absolutely a high tide flag.
Yep.
Now I've only learned that in the last like 3-4 years. Like I got in some of them before, but I consider them to be overly risky. But the reality is they're acting that way because they're so elite.
Right. And we talk a lot about earnings gaps and like huge gaps on volume. Okay, that's another one, right, that I want to talk to you about. So yeah, tell me about that, what that tells you, and how you trade that as well.
So I can't believe I didn't come up with that, because I would say I honestly really don't know if my net worth has been made in 8 or 10 or 12 stocks. But if I've been doing it for 40 years and I caught one monster every 2 or 3 years, you can come up with a number. Half my names I got on earnings gaps, and some of them I wasn't even watching before the gap because the gap was created by a surprise.
Right.
In other words, earnings were crummy or not accelerating at that hyper growth rate, and then they threw one down, and up comes this, geyser of volume and price. And so that's where the pre-market comes in. I'm like, why is that thing up? Earnings season is like the minefield that can give you the golden fruit. I mean, because you can get obliterated or you can find gold. So in pre-market, if it's a liquid name and it has like, say, some crazy beat, I'm going to go in pre-market and I'm immediately going to buy at least 10% before I even know what the heck's going on. It's called my
Of your portfolio
or the whole account.
the whole account.
And so then I'll kind of look into what's going on. And in the first 30 minutes, I wait because these often get faded. This year, in leaders and markets, gaps ups and down have been faded almost in this box in the index. So gap ups get faded down and gaps down get faded up. Last week, we had 4 high closes after down openings. Leading gap stocks up will often give it all up in the first 30, 45 minutes. Now, after that, if it's holding, I'm coming right in and I'm going to take that up to, say I want $20 million worth of stock. I'm going to get that up to 8, 10 million right in the first third of the morning.
Mm-hmm.
Noon, higher, buy more. I might buy a stock. I literally buy stocks like 8 times in a day. Now, if it closes at the dead top tick, I'm going to just cap it off. Let me back up. This is not in a market that's sideways or down. I'm not probing here. We're in a bull trend. Accumulation distribution on all 3 indexes is B to A.
The market just followed through.
Right. And oh my God, that second best time, the first week or two after a follow through, they just all start popping out. It's rare that you're going to get a monster 13 weeks after a follow through day. Then you're kind of going, I missed this name. Is it going to flag or do a 5-7 weeks, a flat base? Double bottoms. I remember Nokia back in, when they had the little tiny phone. You were 3 years old, probably.
Yeah, I don't remember those, but
it had the most beautiful double bottom with a handle on the right side.
Mm-hmm.
If you've read the book Blink by Malcolm Gladwell, I can just look at a chart and go, I just start to salivate. I'm like, I don't even have to look at the earnings, or I find this. I'm like, I know something clearly really good is happening here.
Yep.
Another big thing is like the wall of blue.
Yep.
There's fresh walls of blue and there's stale walls of blue. When you have a cup and handle and a bear market, and then you get a wall of blue, like Bill would say, 5 weeks in a row up is a buy. Well, I just called it a wall of blue. That is like Baidu. At the time, that was my biggest trade ever. It had this gargantuan wall of blue after this really bad bear market. And I just piled into that thing because of that.
Yep.
RIM, same thing, RIM.
And Palantir off the bottom just had that monster earnings gap. And then on the weekly, just look at the volume, maybe even bring that up for just to show folks, just walls of blue, huge volume coming in. And it all started with the earnings gap. This entire move that's happened started with the earnings gap.
Right. Well, first of all, let me back up. Through this period in here and all through over here, this stock did not qualify. It did not have the earnings. It did not, and it failed in through here. I can't really see it. Let me change this. This thing shook people out repetitively. And then right here, this was the game changer.
Yep.
That volume spike, and then it cupped, and then it shook out again. it changed character, and it became alive, and the earnings came in, and now, like, if hypothetically, and I'm not calling for this by any stretch, if we get a 20% or greater pullback, Palantir is like a stock that I have kind of war chest money for the family that I save for bear markets. I think Palantir is I asked my other hedge fund buddies, I go, please give me a list of 5 or 10 names that are bulletproof, that are super I think this fits. And I would endeavor into buying this into a climax waterfall over a period of weeks or a month or two, which is completely the opposite of Can Slim.
Right.
But in bear markets, because my personal accounts, I can't really trade. I don't want to get conflict with my hedge funds. So I saved that money for horrible bear markets where I know I'm not going to do anything.
Yep.
And I ended up, I've bought some of the best stocks in history. When Mnuchin came in on Christmas Eve, and he said, Christmas Eve, he goes, we're going to open the floodgates of money. And the market just had a monster. I went and piled in all the cash I've been saving for 5 years.
Yep. Getting back to earnings gaps and
Oh boy.
SanDisk, I think you've talked about that trade before. Talk to me what happened with the original SanDisk. It's had this resurgence, but talk to me about how you found that stock and how you bought it as well. With that gap up on huge volume.
Okay, so the gap up, I think the biggest earnings beat I ever saw in my life was Amgen. They earned 32 cents against a penny. And SanDisk's volume was up 3,200% on the day. And it was up like, again, this is so long ago. My son was a baby and we had the camera. That's how I figured this out. And so my son is 28. So it was 28 years ago.
Yep.
And it explodes out and it's up like 20% or more. And the volume's running wild. And I just bought it. And I was a retail broker back then.
Yep.
And I just bought it across every single account. I bought it across the board. And I then realized the earnings were like monstrous and the volume's going crazy. And my wife calls. I go, what are you doing? We just had a really young infant. And she goes, that camera we got for the christening? I guess. She said, well, it's digital and the camera only holds 5 pictures. You have to buy this thing called a memory stick. It's made by SanDisk. She says this. I go, I just put half your whole IRA into it, little does she know. And I kind of hung up the phone and I just went and I just mobbed the thing.
Yep.
And it ran up and it goes dead tight for I think like 3 or 4 or 5 days.
Yep.
It didn't give up a point. And it broke out to the highs. And in one trade, I doubled the whole thing, like across the board. And it just exploded. And it went on for, I can't really remember how long it went on for, but it got super extended. And this was before I trimmed extended.
Mm-hmm.
And I go, God, if this thing breaks the 50-day, this was one of the first times I go, it's just so extended. I'm going to let a little bit go. And I go, at some point, it's going to come down to the 50. Well, it was 5 days later. It was below the 50.
Wow.
And it didn't, if this is the 50-day, it didn't glance it nicely. It went like that. And I just threw it overboard, just all of it.
Did it recover or was that?
No, it was toast.
Yeah.
Sometimes when you make another rule, when you have life-changing money, and whether that is from bicycle to automobile or your 1-bedroom house to a 5-bedroom house, whatever, you have to take it. And for me, that was a big one. First of all, half of it was in my wife's IRA, no taxes. I had a ton of it and I didn't care.
Yep.
And I'll tell you how you learn this. When you have life-changing money and you don't take it and it disappears, like that'll teach you.
Yep.
And I continue to do that. Like last year, I'm embarrassed to tell you how much I was up at one point last year. I ended up, I think before fees, I was up like 30 or 40%. I can't really remember. But at one point in the year, I was encroaching on some big numbers. Last year was a abrupt rollover. And a great game to play is gin rummy, because it's a game where you try to get as many cards as you can, match them up as quick, and then discard them before the other guy goes out. Well, when the market goes out on you and you're loaded with inventory, that is no bueno, man. And then you're like, that Bill has the turkey game where the turkey there's 3 turkeys in.
Yep.
Like, do I wait just another day and see what happens? And then you lose another 4 or 5%.
Yep.
I had that last year.
Because like you said, when the growth names break down, it doesn't matter really what theme it's in, what's grouping, they're all correlated. They're all they're gonna be falling all together. Like that's what happens.
All tech goes.
Yep. One follow-up question on the earnings gaps. Now, how you trade them? You said by the first third of the day you want to keep adding. Are you using any intraday charts for that, or you're just
No.
kind of adding? And how are you managing risk on that? Where is your stop if it turns around on you?
Okay, first of all, I don't care if it's up 15% or 40%. And here's another thing. Now, this is where art comes in. I try to get my whole position on before it's up 2%. But when it's gaps open 15 and it's up 25, 45 minutes later, it's hard to get your stock while it's not up 2.5% yet.
Yep.
And you want to spread it out over time because these things fade a lot. I would say half of them fade. So it's a battle between getting your whole position on and getting too big, and then it rolls over on you. So you want to spread your buys out over time, but yet get it. So you have to give it up.
Yep.
And that's where judgment comes in and experience. There's no rule.
Yep.
The rule is losing money, though. So say you build it up, and all of a sudden you can't take a 10% pullback in equity. So you have to be proactive. And I'll tell you this, when you have a stock that gaps like that, if it closes in the bottom quarter, it's like a follow through day that undercuts the low of the follow through day.
Or the expectation breaker.
Yeah.
Yeah.
It's the odds go way, way, way down, and you want to take that position way, way down. And I don't want to hear about the one in 10 years that closes at the dead low and then goes on to be great. It happens. It happens a couple times a year.
Yep.
But mostly that's a really bad signal.
And what's going on behind the scenes of an earnings gap? Like what creates it, and what creates the trend after the gap?
Because so it's new information. The market's adjusting. Analysts are raising guidance. The market has got a gap higher because it's discounting this new. It's factoring this new info.
Yep.
That's why another integral variable into a TML is beat and raise. And beat and raise, I call it the cockroach theory. Like you take your daughter to college, and you look at this killer condo and a cockroach comes out. Well, it's not one. Okay, where there's one on the floor, there's 10 under the counter.
Yep.
They repeat. Serial beaters, as I think what Eve would be. If a company is going to beat earnings by 100%, it's unlikely that it was just a one-time occurrence. Like the product's only good for a quarter. You're going to have multiple beat and raise quarters, and analysts are notorious for I want to keep my job. So they think it's going to earn 40 cents, but they say it's going to earn 35, and then it earns 50. And now they got to raise to, and then the guidance is 60. Like a stock, this is going again back to 1994. It was Ascend Communications, and I bought it, and I looked forward. Estimates were hypothetically, they were $1. Well, fast forward 2 years later, they earned $5. Like, analysts are so far behind the curve so frequently. Analysts, I would say that 95% of Wall Street analysts, and I'm talking about the big dogs, don't know the term true market leader. They've never studied a true market leader. They don't know what they're capable of. They don't understand how massively these tidal wave tsunamis of earnings can beat. When you say to an analyst who covers chemicals or flower pots or whatever, that a TML is going to routinely go up 500 to 1,000%. They look at you like you have four heads.
Yep.
Well, they've never had one. They don't understand that, and they're just trying to make their $400,000 a year and not get fired.
Yep. And sorry to come back to the question. So the stock completely blows out expectations. The company raises guidance. The analysts, the people working at hedge funds, they have to completely redo their valuation. So basically the funds are forced to buy, and they can't just buy once. They have to keep buying and build their position. Is that,
I don't know if they're forced to buy, but they're like, okay, first of all, I'm kind of like a mid-cap, I'm a small mid-cap hedge fund manager. If I'm going in, well, again, I concentrate huge.
Yeah.
These other guys, they're putting 2-3% of the whole account max in anything, but they're still buying as much or more than me. So they're just throwing the book at it. They're like, well, they know cockroach theory. They're the fund managers are totally different than the analysts.
Mm-hmm.
Okay. If the analysts were great, they'd be running a hedge fund. So the fund manager's like, yeah, they beat. I know they're going to beat 3 more times. Let's take this thing up from 3% to 4%.
Yep.
And so, if they're long, 200,000, they got to buy 50,000 more.
Right.
And that's a small position for these big funds.
Yep.
These guys, they often own 1 million shares of a $50 stock or more.
And so that buying creates the trend that we can ride.
Yeah. And they're in the whales, the real whales, they're going to buy it 5 days in a row.
Mm-hmm.
And then there's a lot of times, this is something a smaller guy who buys 1,000 lot can't do. I'll be in for 100,000 or 200,000, and I can see that my order's holding it or moving it. I'll pull it, and if it pulls back, I know I'm the only. I want monsters. I want that thing to really be going up. I want other whales, I'm a guppy. I want whales in there.
Yep.
So if I back off, it keeps going up. Now I know there's at least 1 or 2 other monsters in there.
Are there any other tells that you look for that says, okay, there's somebody really also trying to accumulate stock at this point?
Yeah, the monsters do not back off. And if they open crummy, they close great. They're telling you said, Jim, how do you know has the better product? The stock just acts really firm. It closes firm.
Even on a big red day, right? Like that's a tell.
It's even better.
Yep.
Okay. I call that a leader defining day. When the index is down 2% or more, like you have a slaughterhouse day.
Yep.
I want to know immediately all the stocks at green, even if it's by 25 cents, what is going on. Either the whales didn't sell it or they were actually buying what other people were dumping. That leader defining days are strong signals, especially early. Everything early in a move is a signal.
Yeah. So going back to the SNDK trade, it sounded like you positioned day one, but then it just it basically flagged out and tightened up again. And
it was a super short flag.
Yeah. So is that something you still do today? You add more as it breaks out of a kind of a range right after the flag?
Usually by the time if I catch it on the initial breakout, by the time it gets to a flag, I have a full position. So now, if I'm not in a position where it's gotten so big and it could be detrimental to my fund, I might have to actually sell some. But I'm going to totally own this. The monster stocks I've had in the last 2 and 3 years, I was under positioned in, and they still made my year. So if I am under positioned and it has a 3, 4, 5, 10 days tight, I'm going to add 5%.
Gotcha.
I believe 2 and 3 weeks tight or any little digestion is an add. Taking a full position on a short digestion is absurdly high risk. I would say half of these 2 and 3 weeks tight fail. And I don't want to give up my stock either. So I want that cost down so low that if that 2 weeks tight fails, I can just keep that bulk.
Yep.
I want to, Bill said, get all your money in there, but it's been hard. And that's a perfect example. You get 20% in a stock that beat and raises, you're going to change your life on that one stock. Now you catch one of those every 3 years for somebody who's your age, dude, I cannot wait to see what happens to you. You are going to be knowing what you know at your age. When you're my age, the world is yours. It just depends on how hard you want to work at it.
I'll try. I'll work as hard as I can then. And right now we're in an interesting market environment. Obviously, it's been choppy. Today was really interesting. Today, just for everybody watching in the future, is March 9th. We had a huge rally after oil pulled back well off highs, VIX collapsing. But bring up VRT, the chart, because this is a recent gap up. Obviously, this isn't the first gap it's had. But we were looking at this into the close, and you were saying, this is, a recent gap up that then formed a consolidation. Is this kind of what you were talking about? That if this is a better market environment, this would be something that you're looking to buy as it keeps breaking out of that short consolidation?
Explain to me how this stock was 1% off all-time highs, and the market's down 4 to 6%.
Right.
And it has 99 comp. It has 43% estimates. I said 20% across the board, pre-tax, after-tax, return on equity, 99 comp, RS 97. And look at this bar.
Right.
I'm just going to go straight out. Volume totally matters. This stock the whales did not sell it. and they came in big. Look at this. I call it a skyscraper of blue volume accumulation.
Yep.
If you, so this brings the debate in. Was the market bad enough that we needed a follow-through day? If you still had inventory, you didn't need to buy anything today. But this absolutely could have been, if you had no exposure, this would be actionable. Now, if you were over your skis already, and that's another problem. If you're long a lot of stock and then the market moves through, you're like, well, I can't add. I'm already super long. I don't want to increase exposure. So that forces you to weed the garden. Am I going to blow this out to bring in a new leader? And so having stale big exposure, it can keep you from, it can help, it makes you miss new leaders.
So we've talked about entering on a gap right now. For a cup and handle breakout or a flat base breakout, if you're trading that, how is it different that you enter with that type of setup versus a gap? Or what are you looking for to say, okay, it's at the pivot? What do you want to see to enter? Are you watching the daily, the intraday? Bring me into kind of your mind there.
Okay, so Bill was super strong on weeklies. I learned on dailies. To identify the exact pivot. I use the daily. And if it's a cup and handle, I'm probably aware of it before. And I'm salivating at the possibilities. And then the temptation is buy it in the handle before it comes out. So occasionally when I just get overwhelmed, I might buy a tiny little 1 or 2% of equity position. On a earnings gap, I'm probably not aware. So I'm going to pay whatever, but with a cup and handle, I want to be the dude breaking it out.
Right.
So I want to be the, 10, 20 cents over the pivot. If it's $100 stock, maybe 50 cents over, I want to just call the trader and say, I don't care, just not held, buy 100,000 or whatever. Right. And I want to see that thing just go to Mars. Like I want to be the fuel and I want the whales under me. And so I'm not willing to chase a lot over a handle. I'm willing to chase a huge amount on a gap up.
Gotcha. And let's say the breakout, it had all the qualities you're looking for, but instead of closing at highs, ideally, following through the next few days, which is the ideal, it reverses on you. How are you managing risk on that? Taking care of that side of the equation. So if it fails, you're protecting the majority of your capital.
I'll scale out a little bit if it reverses. Again, I'm going to open up to a bigger loss than normally. A 0.5% of equity, if I'm up for the year, is about what I'm willing to lose on any given trade. But when you're in these gap ups that can just be absurdly violent, you kind of almost open yourself up you certainly open yourself up for the possibility because they can roll over faster than you think. But a lot of people say, I'll set the stop at the bottom of the gap. Well, if it's up another 10%, you can't do that. Right. You just have to look. This is an art largely based in rules, and it's not always going to work. But I will tell you that when I started cutting my losses, when I read Bill's book, I started to go, well, I keep cutting all my losses. Eventually, I'm going to tangle up into a monster.
Yep.
And I did. If you keep buying monster gaps and you get stopped out of some of them, they don't work, they roll over, or you screw it up, like out of not negligence, but inexperience, you mishandle it, keep after it. Like we were talking today, we were 4 or 5 months into a Darvis box and half the people have left the market already. Are you kidding me? You're going to get kicked around. The rules are they're going to fail you. You just have to stick after it. I mean, if you want to get serious rich and you come from a middle class or low income family, you need to compound. Like you're not getting an inheritance. Okay. You saved up 5, 10, 20 grand. You want to be worth 300, 400 million bucks. You're going to have to compound that for 40 years. So you're going to see bear markets that are going to last from 9 months to a year and a half. You're going to see pullbacks that are going to last for 2, 3, 4 months that are going to be 30%. You're going to make 1,000 mistakes. You're going to screw it up. You're going to have to dust yourself off and get back on the horse. And so how do I handle the gap? I might have to take a little bit bigger risk. I might screw it up. I might not get enough. I might like APP. The reason I didn't have 20% is it just exploded.
Yep.
The rules are no guarantee. They're not locks. They're guidelines. They're guardrails. They're really more to keep you from blowing up. And if you do follow them, I promise you, you are going to catch many monsters.
Yeah. No, that's perfect. And on a more typical breakout from a cup and handle, you've got your kind of laddered stops 3, 5, 7. Is
Yeah.
that correct? So that's how you're protecting yourself.
On a cup and handle,
Yeah.
super rigorous on 357.
Yep.
On a massive gap up, I mean, dude, you can, if it gaps up 10% or 15 and you fill 5-10% of your position or equity, you can blink and it's going to be up 5 more percent.
Yep.
And if it's in the mid, if it's 30 minutes into trading, now you got to choke and, swallow hard and buy up another 5%. Now your cost is too high. And then it just keeps going.
Right.
Now all of a sudden it's hour and a half before close and it's mid range. You need to make some decisions.
Yep. And you've mentioned position sizing quite a bit so far. So just to bring it all together for folks, what is your target size? Let's say in a good market, in a good opportunity, what is the target size you're looking for as a percentage of your portfolio? What's their max size you're willing to do? And in your earlier years, your cowboy years, what were you doing back then?
Okay. I mean, I was just off the rails. I mean, my office manager would be like, we got to bring you back on the reservation, son. I mean, I would take, but I didn't have any money. I had like 20, 30, 40, 50. I had no money.
Yep.
I would take it out 3X. I'd have 50 grand out, 150,000, and I'd have 3 stocks. It was like suicide. Like here's what until I went to Bill's level 5 or master's class, I didn't even recognize what he wanted for parameters.
Mm-hmm.
And I go, how did I not blow up? It's because I had 357. Or I know I was set back then, it was just 7%.
Yep.
And I was really, really rigorous about that. I am absurdly disciplined in one area of my life. In the rest of my life, it's just chaos. But it's what kept me alive. Most hedge funds, I think the number is like 70% of all hedge funds blow up in 5 years. In 3. The fact that I had such loose position sizing and I made it is amazing. Now I have found unscientifically that 18% total exposure is about the max I can really deal with. If something is crazy liquid
In one name, just
in one name,
yep.
I can take it up to 20, 22. But if that thing doubles, it's 40% of my account.
Right.
And then I got to go through an earnings period. Like when NVIDIA first came out, this is 10, 15 years ago, it grew to half my account, and every earnings report for a year or two, I had to trim off. Now the question is begged. It begs the question, well, what if you would have held it the whole way? Well, I would have never gotten there because now the whole 80, 90% of the whole account would have been in it, and any miss, it would have been obliterated. So I actually made more money by keeping that position, trimming it before every report.
Yep.
Having a stock that's going to triple and having a size will kill you. You can't tolerate. Even with my cast iron stomach and ability to take risks that most people can't, I can't do it. And if you do it, you are going to sell the low.
And you bring me exactly to the next question I want to ask you, Jim, which is about handling a monster stock and like getting the most out of a trade. Because like you said, if you can't hold a stock and then 5X's without you,
Doesn't matter.
Does you no good. So what are the principles, the sell rules that you've internalized to try to hold what could be a monster stock so you can get the most out of that trade?
Okay. Can slim, screening for stocks, all the things we've talked about up to this point is the basics. This is how you handle a real TML, a bucking bronco with size that is the game. That's the apex. That's the self-actualization. And the answer is, if you're not trimming or hedging, and you have size, you're not going to make it. It's experience. It's knowing yourself. Like you have to say, look, if this thing pulls all the way back to the 50, can I deal? And everyone says they can until it starts to happen.
Yep.
And another thing is, if you think about it hey, I could have bought a summer home with the first pullback and I lost it. You cannot, I say you have to have a disrespect for the money, because if you're counting it, you're done. If you're counting it, you need to trim it. If you're above the 50-day by an amount that you couldn't take the drawdown, at least down to the 50-day, you have to trim. because you'll never make it down. You will puke the low. Now, my evolution was I would sell 15%. That's nowhere near enough. I need to, initially I was trimmed, now I hedge. I think I need to trim or hedge at least 50% at a extension that is equal to or getting close to the recent level of extension before the pull it back. But I think it's even more than that. Like in some cases, I'm actually overhedged because I just am so confident it's going to pull back. Like one thing you can count on is a pullback. You cannot count on for higher prices.
So there's a little bit to unpack there. First things first, extension. A lot of people watching this are going to be like, how do you define that? And I'm sure there's art to it. Are you looking just visually how stretched it is from moving averages compared to prior trends? Are you looking for a hard percentage or ADR from that? How do you personally define extension?
Okay. It's time, duration, and percentage from the last level of extension post its breakout. Because the personality is very different before the breakout versus after. Before the breakout, the market might not let it go 5% over. After the breakout, it might go 35 or 45 or 50.
Right.
So in the initial leg up, I look at time because I don't know I just eyeball it. And I start building into it. I don't just go, oh, the last level of extension was 30%. At 30%, I'm going to hedge off 80% of it. At 25%, I might sell or hedge 15% of it. And every 3-4% higher, I'll more. When it gets to like all of a sudden last extension was 30, it's at 35% over. Well, I'll take my max extension, my max hedge, say 75%, because you never know if it's going to climax. You never know if it's going to get bought out. Now, again, in 40 years, I think I've had 3 buyouts. So you can't count on that, but you don't ever want to let go of all of it, just in case.
No, that's perfect.
Time,
yeah,
in duration didn't really factor a lot for me until like the last 6 months. I just went on level of extension, but now I've had a lot of levels of extension get reached, and I'm like, well, it's only 2 weeks out of the base. It's likely to run for 7-8 weeks, which makes it an art. There's no rule. You don't know.
Yep.
You have to read Annie Duke's book, Thinking in Bets, because in the market, you're playing Hold'em. There's all these variables, like the flop is down. You don't see those cards, and you don't see any of the opponent's cards. So you don't know what earnings are going to be. You don't know if the Fed is going to cut rates, if there's going to be a war. There's so many unknown variables. So it's an art. You have to work into it. And I would say that experience, 40 years can give you a little more insight.
Yep. And let's say you're holding what you think is a monster. It's extended now. It's X percentage above. Is it the 50-day moving average that everyone watches? How do you structure your hedges? Let's say you want to hedge, let's say 50% of your position. How do you structure that? Strike price, duration. Let's get specifics here.
So I would ideally like to sell the call at the 50-day, but often that's so far below that the spread between the bid ask is gargantuan. So I sell what I can. First of all, I'm using a market maker.
Yep.
So I have a little bit of an advantage. They'll introduce capital and they'll fill me right between, where most people have to pay the offer of the bid. I will sell 5-10 points in the money. Now, this is what happens when it rolls over, it gets to your strike, and you're like, you cannot freeze. You have to buy that back and then sell more lower, because if you don't, you're naked. You're naked long. So you've got to be quick, because they move really, really fast. And so you put it on as a single leg. When you roll it down, you spread it. You unwind the high strike, and you at the same time. You'll get a better fill that way. And then, is that what I'm doing?
Yeah, I think that's perfect.
Look, this is an art.
Yep.
All right. There are rules, but then there's interpretation of the rules, and there's implementation, and then there's imperfection, and then there's the unknowns.
Yep.
So with all these variables that are working against you, my hedging, I'm often in the name, and it rallies 10, 15 points in my face, and I've got a delta neutral hedge on. So all I made was the time involved depreciation. I didn't lose any money. The stock went up, the option went up. I didn't lose anything. But I, like in BE, after it had its first monster rollover, I was in and out of it. I was getting the thing average daily.
It's like 12%. It's huge.
It's like, it's almost double 8 to 12% a day.
Yep.
Look, all I can say is you implement to the best of your ability consistently for 40 years. You're going to have a lot of failures and you're going to catch a couple golden geese. You only need, golden geese are rare. And when you catch them, it's a life changer.
Yep.
And if you catch only one every 3 years,
yep,
you catch a golden goose, you catch a monster TML every 3 years with 18% of your account in it, what more do you need? I mean, you may want more, but you certainly don't need it.
Yep. So that covers the hedging aspect of it. What are the other very key sell rules that you use to manage a position? And we can talk a climax run, also just kind of rolling over and breaking below the MAs. So talk us through your sell rules.
I am so basic, dude.
Yep.
Climax run, but I don't get a lot of them.
Yep.
That's just pretty automatic. And the big mistake there is you have not been in them before, so you don't understand. Like I initially, like 20 years ago, I'd sell too much too fast.
Yep.
So now when it gets climactic, I start to let a little go. But
10% of your position each day or a little bit more than that? What would you say?
If it's some tiny little thin stock, I'm not in that, but so I have a small cap fund and occasionally we've been in that. I would advocate like Tilray. Do you remember that?
Yep.
I would be out of half of it on the first leg, day up. And
right,
because when that thing rolls over, it's going to implode.
Yep.
Like a SanDisk, if I had to do it over again, I would sell 15% 5-6 times.
Mm-hmm.
Now, again, there was a SaaS name, a consulting name in Chicago stock. It doesn't really matter. It opened up 35 points after a climax run. And I was a big, big, big holder in it. And I let a little go and it was up 30 points and it's now up 15. And I blow another 15 out. And by the time that 15% got sold, it was even.
Yep.
And I just called the trader. I go, sell everything you can.
Yep.
It closed down 30 points.
Wow.
Everybody knows the name of the stock. But now you get a liquid name, like a real liquid name, you can take your time. You can sell over 6 days.
Yep.
Like a Qualcomm back in the day. If NVIDIA ever blows off, you're going to have plenty of time with that.
Yeah. Okay. So talk about then selling if it just kind of rolls over.
Market.
No, but what are your sell rules? Well, yes, it's a market order or whatever.
Or you're in trouble.
Yeah.
Okay. If you get a gap, multiple 3, 4, 5 days in a row gapping, and then it goes negative on the day, it's just, you sell. It doesn't matter if you knock it down $5 or $10. Like you literally, there's going to be an air pocket.
Yep.
You get a gap up and then a reversal down.
Yep.
The odds of it making a higher high in the next week or month are like 10%. Like SMCI did it, but it was such a marginal new high and it was a crummy setup into it. You're doing yourself, look, you've already hit a climax run. Just chill. Okay.
So let's say a more, not a climactic run, but the stock just starts breaking down. What will get you to sell a stock that maybe you're up 40%, 50% at that point? You think it's still a true market leader, but obviously you need to listen to price action. We buy based on technicals and fundamentals. We sell based on
general market conditions are going to have a lot to say.
Gotcha.
Are other leaders, have a few other leaders climaxed or climactic? Where are we? How far from the past follow through day? How far from last bear market? I'm not going to lose my mind 3 months after a major bear market.
Yep.
Okay. Now 3 years into a bull run, and things are shaky, and we've had a couple climax shows. I'm probably going to sell a stock that, it depends. Am I in protect the portfolio? Like, do you manage by P&L or by rules? P&L is an emotional sell. So a lot of times you're going to have stocks like a BE, which are just all over the place.
Mhm.
And so in that case, you have to have a position that's small enough that you can say, I'm strictly going by rules. Because if I just looked at the P&L, the volatility is going to get me out. Like people say sometimes, well, how'd you hold that stock? 8-week hold rule. It was all over the place. And I gave back an absurd amount waiting. And then it got its act together and took off. So the 8-week hold rule is really, really good. But
And define that for us, just for people to
it's up,
know where
if it's up 20% in less than 8 weeks, you have to hold it for 8 weeks. Or
from the breakout or
from the
buy
breakout.
point. Yeah.
Is that right? Or is it within 2? I don't know. Look, these rules are malleable. I mean, they are and they aren't. There's no 357 is a zero defect policy. Like there's just no
side.
I'm just not going to ever violate that. If a stock's down 5%, but it's dead on the 50 and their volume is dead quiet, I'm going to give it a minute. I take a little insurance policy and see what happens. I might let less go than normal.
Right.
Another thing is, how close to 1 year long-term capital gains am I? Do I want to blow it out or do I want to hedge it? Is the market imploding? Am I taking on water? Am I too big? Am I on margin? Is everything melting? Or is everything chilling? I just have one problem stock. Right. Let's blow that thing out. I don't blow much out. I'm a holder, man. I've grown from a frenetic trader where my mailbox, here's old am. They used to send me a confirmation in the mail for every trade. The mailbox would be like the guy'd have a duffel bag of mail for me.
Mhm.
I'm not like that anymore. I trade as little. I want to be forced to trade. I want to be like, a stock's moving so aggressively and the volume's so enormous that I have to get in or I have to get out. If it's ambivalent action, I'll wait. I'll wait for a Friday close. I just don't trade. The less you trade, the less likely you are. The more you sit. Livermore, the big money's in the sitting. It absolutely is. You're going to get rich taking 5-point gains on 1,000 lot and live your life on a razor's edge. I'm over that. I'm just over it. I have no interest in a 5% gain. I'd rather take a 5% loss. It doesn't matter to me, right? I'm looking for, I used to say arrogantly, I'm a big game hunter. I'm a 6 beaten race quarter guy. And I am, but I'm more subtle about it. That hyper aggressive trading is over for me. Paying funder tax bills. I still pay short-term gains on over half my stocks, at least. But you said, when do you sell it? When it's just rolling over. Well, how close to 1 year am I? If I'm 2 months away, hedge.
Yep.
If it's, if I'm 10 months away, blow it out. And another thing is, like right now, I just dumped a huge position in Russell a couple days ago because there's a pivot just right above it. If this rights itself, which I don't know, if it does, I can get right back in. Right. Is there a clear, concise pivot higher? BE is a mess. It looks like a scrambled egg. Where do you get in on this thing? If it let's just say the market bottoms, right? Well, I'm interviewing you.
Yep.
What are you going to do? BE makes an all-time new high Thursday.
I've already got stopped a few times on PE. So, yeah, I would put it on because it's just showing its strength. So as much as I can, while managing risk. Ideally, it pushes higher, low, tightens on the moving averages, pulls back, and then goes, and then lower high. Is that what you're looking for, or what are you looking for?
I just think it's a mess. And
Well, it needs to tighten. That's what I need to see.
We both want to see it tighten up, but I'll tell you this. Why do I hedge so much when things get crummy? Because when the market turns up, I'm long the leader with a low cost basis, and I can just take my hedge off. Now, again, right, it could fade. It could fade the breakout, and I got to throw the hedge back on again. But I'm seasoning that time. There's so many variables on everything.
Yep.
The factors.
Yep. But just to put some rule that maybe for the beginners out there, I know the 50 SMA is your guardrail. So how would a stock need to act around the 50 SMA that says, okay, I need a hedge or I need to sell some for you?
I'm going to be hedged way before it gets down there.
Yep.
Now, when it gets down there, this begs a different question.
Yep.
How many stocks get supported on the 21-day? Not many. So I'm not going to cover it at the 21-day. It gets down to the 50-day. Is it going to stop at the 50-day or is it going to undercut? So where do you unhedge? Do you unhedge half of it, part of it? The answer is, how does it come down? Does it come down on waterfall volume, or is it slowly, subtly come down like a feather at like 3 o'clock or 1:30 on a clock face? I might not sell any of it, even if it breaks the 50 by 2% and it closes 2% below on a Friday, and then the next week it closes 2% below on a Friday, and all of a sudden I start to see a tight line forming. I'm going to start getting really bullish.
Right.
Now, if this thing comes, say it comes down to the 50 like at 4:30 on a clock face, and volume's just overwhelming, I'll probably blow it out. I'm probably not going to hedge it.
Right.
That would signal to me that the whole move might be over.
Gotcha. And you touch on this because it's such a crucial part, but how does the general market and the macro environment, how is your process influenced by that in terms of how aggressive you're going to be and all that? And what do you use to judge the market? I think you want to talk a little bit about the VIX. That might be interesting to bring up. But yeah, take me back. General market, obviously the M and Can Slim, how important is it for you?
You can't make money in a sideways market. Okay, 9 stocks out of 10 are going to go the way of the trend of the market. So that's why everyone's been getting chopped up. You've been buying breakouts. The next day it rolls over. I never, until last couple of years, understood the importance of the alignment of the MAs, not for support, but for a bullish alignment. 21 above the 50, 50 above the 200, and early, where they're fanning. That
They were
compressed like they are.
Yeah.
See, we're set up right now. There's a lot of fear out there, and the MAs are all compressed. And if we somehow get an upside breakout, and the MAs start to fan like this, I'm going to try to get as long as I possibly can. I mean, again, I don't do that anymore. So it's funny. I say I'm not a cowboy anymore, and then I find myself like on margin. So what's your question?
How the market, just how important is it for
huge? It's huge. And how do you tell if you're in a good market? How many liquid quality 99 comp leaders have broken out recently? How are the MAs? How far apart are the MAs from each other? Are they in bullish alignment?
Right.
Is the accumulation distribution on the indexes at least C+ or better? Can you, dude, number one, can you make money? Have you made money on the last 5 stocks, or you've been stopped out? You get stopped out on 3, 4, 5 in a row, position size has to come down. And you didn't ask me this, I'll just tell you. Most anyone can make money in a bull market. But knowing when to back off the accelerator or actually hit the brakes, most people will make money in a bull. And here's how I know. Because they all come to me after they make money and lose it, and they go, here, you run it. I get that. That's where my customers come from. Because they don't want to deal with it anymore. Because they've learned it's easy to make money in a bull market. It's really, really hard to give up the adrenaline rush, the feeling of success, the admiration from your wife and your friends at a cocktail party that you just bought a Lamborghini. You're like, oh, I can't let this stop. I got to keep it up, man. And after having a long, long successful career, you are still completely susceptible to stupid, obvious mistakes. It never, ever, ever goes away. Human frailty is in your DNA. You cannot cure it. Okay. You can spend time on the couch and learn what your defects are, but then controlling them. Like Charles Harris, he's like, knowing what you did is not enough. You need to know why. If you don't know that, get on the couch. Because if you don't know why, you will boom and bust for the rest of your life. And that's where Brett Steenbarger comes in. Like if you don't have access, you need to know the market is the greatest psychologist there is. There's no better. If you can interpret the feedback the market gives you, you can lie to your shrink. You can lie to yourself about the losses, but they're there. The market is going to, if you're greedy, if you're fearful, if you're impulsive, whatever it is, the market will expose you, and it will expose you very, very quickly. And then when you ratchet up the pressure with the size and margin, it's going to teach you quicker.
What are some ways for you personally that have helped you dive into, your actions, the trading psychology aspect of it, and understanding yourself better so that you can hopefully realize in the moment when you're letting yourself get carried away? How do you help build that awareness?
I started going to a shrink in '07, and I went very frequently. Now I go maintenance
Mhm.
like once a month. Uh, when you just have an unbelievable look, streaks are real. Baseball hitters, 3-point shooters, stock traders.
Yep.
When you just can do no wrong, you are in the flow
You're
state.
seeing the ball. Yeah.
Trim, let something go. I emailed Kramer 30 years ago, like in the 2000 blow off. That's 24 years ago. And he just sent me one word back, trim some. And when you're just feeling invincible, it's like the first time you think that's going to go on forever.
Yeah.
When you give it back, you're like, okay, I learned, but you're going to do this repetitively.
Yep.
When you just feel invincible, it's just recognizable now. I'm 40 years in the business. When you're just so hot, when you, like I said, I'm so basic. I'm great at selling into climaxes. I'm great at selling breaking the 50. It's the in-between part that you asked me about before.
Yep.
That's where you really have to make some decisions, and you have to know why. Why the heck are you 200% long to begin with? Okay, what are you trying to prove? Like, are you trying to get rich immediately? The market's going to teach you.
Yep.
I guess there's a time for 200% long. When I was trying to build my war chest, I was 200% long a lot. And I did take 5 points out of 1,000 lots until I got a little critical mass.
Mhm.
And then slowly over time, that just kind of went away. I don't think I'll ever be 200% long again in my life. I'm way past that.
Yeah. Ross Haber, who of course I work with, he says he's optimizing now for aggravation-free trading, like the names that just trend. And he says now how the markets have maybe sped up a little bit, being 120% long feels like how 200% long used to feel. So, yeah, that's just something.
Why do you want to get rich? Because you want a great life. Well, a great life is not glued to a computer. Okay, you don't want to be sweaty. You don't have heart issues. You want to live. What if you just compounded out at 18% a year? You'd be Hall of Fame money manager.
Yep.
Hall of Fame. When you have smaller amounts of money, you can do much better than 18% a year and still live a life and have a life. It's like, is getting rich worth a crummy life?
Yep.
So again, I lived a life of zero balance for 20 years or more. And I didn't understand what the heck that was. And I thought I loved it. I now look at it more like I'm still going to go for the 100% year when we come out of a bear.
Right.
But if I have a 20 or 30% year this year, I'm going to be pleased. I had an 80% year, 100% year, 05. I don't know whether you're talking about before or after fees. And then I had, look, if I just compound at 30%, I'm doing it to like, one of my friends, he just had a birthday. I'm having to draw a complete blank. He's Mr. Zen, Robert Furman. He's an evolved version of me. Super. I'm not comparing. I know who you are. You're the big deal.
He's the man.
He is totally the man. I go to lunch with him. I hang out, play golf with him.
Yep.
He enjoys his grandkids. He has compounded for 40, 50 years.
Yep.
You think he cares about a 300% year? Yeah. Oh, he'd love that. You think he would trade time with his grandkids and playing golf? And no.
yeah.
So quality of life, I probably gave up a lot of years of my life. I have high blood pressure now. So today, should I say it?
Yeah.
We're buying NVIDIA, big block of stock, and we're trying to figure out what to do. He's in my office, and I go, I got to take my blood pressure. And it was so low. It was the lowest reading I've had in a month. I couldn't possibly believe it. But that's what I want to be.
Yep.
I want to build a portfolio that I don't have to have it on the counter while I'm in the shower. I'm going to be able to walk away from it for an hour, play a hole of golf, play 2 holes, check in. It's about a great life. That's what we're trying to do here. Getting rich is about having a great life. to buy you the opportunity to have a great life.
So you talked about that 20 years of imbalance, basically.
Total imbalance.
Do you think you need some imbalance at the start to kind of test yourself, push the boundaries a little bit so you know how much you can take? Or, what would you kind of say to that?
I would say if you have a job, you stay in that job until you have 4 years income to trade all on your own. Once you have that, you're probably going to feel a ton of pressure. I think the pressure of trying to earn enough money and not have an income is enough. You don't need to lever up and you'll get there. Like, again, get an HP 12C and put in whatever you have and compound it for 30, 40 years at 15%. Take out taxes. You don't need to sprint, because when you sprint, you're going to fall hard. Ask Furman. Okay, I had no balance in my life. I would sleep 4 hours a night. I would look at currencies in the middle of the night. I would look at foreign markets. I had positions that were so big, I would dream about the tape for decades. Now, when the bear markets came, it was all cool because I didn't have anything to worry about. I wasn't in the market. But when the market was on, I'd have to take Ambien on Sunday night to get at least one good night's sleep. And then I would go on 4 or 5 hours a night for the rest of the week. And I'm over that. I'm done. I'm finished with that. It's the evolution of a trader. And do you have to have the imbalance early? Do you think Michael Jordan had any semblance of balance in his life? He's dragging Rodman out of his place at 3 a.m. to go to the Burrow Center to shoot hoops. I mean, you want to operate at the very, very highest level. You're not going to be a great hockey player and slingshot player or whatever. It's one thing, but I guess if I had to do it over again, I would dial it back a little.
Jim, I wanted to hear your take on AI, both as a disruptive theme, as something that could create many market leaders like we've talked about, and what sub-themes within that you're focused on. But also, and we can take this as the next question, but how AI might impact trading and how we operate as growth stock traders and all that. But first things first, talk to me about the AI theme, what you're focused on in terms of how it can create these great opportunities that we discussed.
Well, right now we have the plumbing, we have the facilitators, the hardware,
the pick and shovels.
Right. We had search engines for a very long time before Google came out, and we haven't seen any IPO of any monster dedicated, singly focused AI name. So we are absurdly early in this run, and this market.
Are you bullish, Jim? Are you telling me you're bullish?
Well, I'm not just bullish. I'm a 40-year trader, and I've never seen an innovation like AI. There's nothing like it. There's nothing I've ever seen. I understand the possibilities for robots. I understand the possibilities for biotechnology because of AI. There's the innovation we're seeing is like the steam engine with electricity at the exact same time. The implications first of all, the market right now is not trying to find any winners. They're trying to find the losers. The market is poking like a mouse pokes at a wall, trying to find the
names dropping.
The water is trying to find that crack.
Right.
So we've got the trucking stocks have been obliterated, SaaS stocks have been obliterated. Who knows what's next? So right now that's the mode the market is in. But there's no chance these guys are not going to monetize. And when they do, first of all, there will be more losers than winners. Okay, in crypto, I know, just 1 second. This is good. I suspect that every crypto outside of the top 100 market cap is going to go to zero, and it might be as much as the top 50 might be the only ones that survive. AI is going to obliterate any company that has a boardroom with mahogany like this desk, and they have 3-piece suits and they're smoking cigars. These dudes are roadkill. The possibilities for what these winners are going to do, like we're in the kitchen today, and I said, God, you're 28, and I'm 61. If I look at every winner that Golden Goose brought us from my age 28 to my age 61, we're going to see that over again with Turbocharger. And what do I think about AI? I think it's going to, Elon Musk says it's going to create such massive abundance that money won't matter, that you'll have to find a hobby. Now, I can't envision that. I can't get my arms around that. But just when I use AI in the most crude way, like I say, please, I query it on the 50-day. How many times did it touch this? And I have Josh Darwin, thank you, and some other really smart guys helping me out. What this does in 3 seconds is beyond. Like, it's so, the implications for this, dude, I'm telling you what everybody knows. It's unbelievable. But the old dudes are like, well, it hallucinates. It's not dependable. Well, it's just this is as bad as it's ever going to be. Like Jim Schmidt says, it's not they're spending too much. It's that they haven't spent enough. Now that begs another issue, and that's the data center debt problem.
Mhm.
So there's a lot of factors going on. Is it going to be contained to Blue Owl and Jeffries and a couple others, or are we going to get contagion?
Right.
So right now the market, the three major variables are AI destruction, Iraq, and like these. There's one other, and I forgot it, but the market's, and ferreting out losers. That's what the market's dealing with right now. It's not looking for opportunities at this minute, but there's no chance that these guys are going to not come public and not throw down triple-digit sales and earnings. Some of them are going to do it. There'll be 5.
Yep. No, that's perfect. And like you're focused on, we've talked about BE, which is like AI energy, that enables the grid to support this stuff in that transition phase. What other sub themes within AI are you personally focused on and like digging for opportunities?
Okay, I'm digging in one place.
Yep.
The new high list.
Yep.
I don't have to know because it has to show up there. I don't know.
Yep.
But it will bubble to the surface.
Yep.
Like right now, I think Fastly edge computing is breaking the workload down and making decongesting. Like BE is just like, it's the ultimate solution. It's behind the meter. The only issue with BE, well, first of all, it's green. It's so simple. They can scale that thing up in 3 months or something. I'm just concerned about their capacity.
Yeah.
Like I've been in stocks before that had a product that was so absurdly hot. They ran the factories 24 hours a day and they just couldn't meet demand. They were sold out 3 years forward. I don't know if BE is there. Right. And that's why there's volatilities in there. But other areas of AI, again, I am not a technologist. I'm a dyslexic C student, bro.
Yep.
This is above my pay grade. But like you said, Jim, I can code. I can create trading software. The implications are off the rails.
Right.
The new high list is going to show me, like right now, it was memory stocks and fiber optics. We'll see. But names that you were dormant, Western Digital,
yep,
was a slug. When that started popping, I'm like, who cares? I didn't even believe my own system.
Yep.
We're going to see more of that. There'll be some old world leaders. Wait, you know what I think? How about this? If you and I have a company with 1,000 employees and AI allows us to fire 100 of them, well, our margins went from 12 to 15%. What if every company in the S&P's margins goes from 12 to 15%? What's that worth in growth in S&P? 30, 50%? Okay, now what if these companies are going to grow faster earnings? The average earnings growth of 5, 6, 7% is going to go to 10 on top of a PE expansion, on top of a margin expansion. Where can the S&P go? On top of the greatest level of innovation across all industries we've ever seen.
Right.
That's what I think.
We'll see. We'll see.
We will see the new high list.
Yep.
And let's say I'm wrong. I have massive cash right now. Okay. Until we have green signals, it's chill time.
Yep.
I could be completely wrong and it will not change my net worth. I might lose a little bit, like percents, but what if I'm right?
Yep.
See, here's the thing. If you don't believe in the big picture, if you don't shoot for the stars, well, you're never going to catch these monsters. If you're a valuation guy, you're going to miss all these monsters. They're never going to be cheap. Optimists prevail. Optimists win. Chicago floor traders were invariably fading the crowd. There was a lot of pessimists on the floor, and they got what they thought was wealthy. They retired early, and they're broke. Now, I have some friends who kept their money, but most of these guys, they're broke. They're pessimists. If you believe, you have to believe. You have to take the leap of faith. Like in Indiana Jones, you got to take the leap of faith.
Yep.
those are the guys who believe that a stock can go up 50 times. If you're like selling everything up 10% because, well, I don't believe it. It's going to fail. It's going to fade. Pessimists, no place for you. You know what's worse than pessimists? Fear. Fear is the great killer of big success because you'll never stick around.
Perfect. And the second half of my question, do you think he'll have an impact on how we trade? Like how will it impact price action? It seems like news gets interpreted even faster these days than ever before. A tweet goes out, the markets react instantly. Do you think it will impact that more? And then also, kind of not quite related, but the 24/7 markets that probably will come. How do you think that will impact what we do as CanSlim Foundation traders?
So do you remember when Newt Gingrich asked Bill Clinton if he was still relevant because Gingrich had the contract with America? Well, I want to be relevant, man. AI is not wiping me out. Like, in the end, human psychology drives price. And again, if I just watch the new high list, it's inescapable that a stock can go from 50 to 300 without making a new high. So wait, am I going to be or obsolete? I suppose anything's possible, but I just believe, again, another thing is, if a company earns $1 this year and they're going to earn $15 in 3 years, and the Fed is neutral or easing, that stock, it almost has to go higher. So as long as those variables don't change, I think it's more human nature. I don't think AI can destroy human nature, fear and greed. On the other side, 24-hour trading, I was opening my crypto fund and somebody who's around my circle goes, "You can't do it. It's 24 hours a day. You can't." I'm like, get out of here. I opened the fund and I've done just fine. You have to change well, first of all, initially, the liquidity is going to remain. There is 24-hour trading right now. You have Thinkorswim, you have some tokenized securities, you have I can trade in after hours, or I just call my broker,
right?
Or I do it electronically. But there's no, even after monster earnings reports, good and bad, the liquidity dries up 2-3 hours later. So the main liquidity will be in the regular trading hours. As time we evolve. If there is there just won't be the liquidity that there would be if you clustered it into one space,
right?
But if we do get markets that no one's going to release critical news in thin markets. So, but if they do, you'll have to change your style to longer term. I mean, no company's going to report earnings at 3 a.m. They're just not. But it is a challenge. But look, there's currency traders. Currency trade 24 hours a day. We'll adapt.
Perfect. And Jim, I now want to get to some fun stuff.
Okay, let's do it.
So to start with, you talked about those 8-10 trades that, net have been responsible for your war chest, the big moves. What are some of those trades? And I'd love to go through a few of them, the chart, hear the story behind it, how it got on your radar, why it appealed to you. So yeah, what are the key ones that come to mind that you'd love to talk through?
It's not fair because I'm romantically attached to Broadcom.
Yep.
Back in 1999.
Do you want to bring the chart up, by the way?
I can't.
Oh yeah, you can't.
Doesn't go quite that far, but I could just show you. This is your book.
Yep.
So see this 1, 2, 3.
Yep.
This was like a base I saw in Broadcom, and it went over this high, and I bought a third. It went over this high, and I bought a third. And went over that high, and I bought a third. And the stock went to freaking Mars. They invented. They had a chip for. Well, okay. At the time, everybody was on dial-up. And how old? You were 5.
I've seen dial-up, so don't worry.
Okay. So if you wanted to download ESPN, it could take 30 to 60 seconds to load the page. And then comes high speed.
Yep.
And there was DSL, cable modem, and satellite. And Broadcom had the chip for all three. And I recognized that like 2% of the population had high speed. And I'm like, well, I had it. I had whatever the thing was called. And I'm like, oh my God, everyone's going to, the total addressable market is everybody.
Right.
And these are the guys who have the chip for all three. And they had that beautiful base. Well, it was a totally atypical base, by the way. And I just bought those 3 lots and it just exploded. And it had a 35 or I can't really remember. This is 24 years ago.
Yeah.
But it had like a 25 or 30% pullback because a lockup came off. and it never broke the 50. So I didn't sell it, but my drawdown was $400,000. And that was a lot of money to me. Still a lot of money to me. And it came out of there and it just took off, and then it climax ran and I blew the whole thing out. And it was a first stock I made $1 million in one trade. So that just is like that probably doubled my war chest. I'll never forget it. And I still watch the symbol. But then SDLI in early 2000 had almost the exact same pattern. And I got stopped out the first time. And I remember I was so pissed. I was playing golf with my wife, and I ended up walking off the golf course because I was so distraught. But it regained its composure, and I bought it all back, and off it went. And I had another stock at the time called JDS Uniphase.
Mm-hmm.
And JDS Uniphase acquired SDLI, and they both blew off together. It was a bonanza. It was I think some people know this. I did a thing with Arusha called War Stories. So I'm pretty sure it was SDLI, and I had 3,000 shares. And I wake up in bed and I look at the tape and I go, oh my God, it's down 100 points. I'm down $300,000. And I just take the covers and I pull them over my head and I go, so about 5 minutes later, I pulled the covers up and I was wrong. It was up 100 points.
Yeah.
And that was the blow off. It was the buyout. And then it was a share acquisition, was a cash deal. And then Uniphase blew off too. There hasn't been a lot of moves like that. Like SanDisk has been that kind of percentage type move. I missed a ton, and there's a lot in between there, but I can go over what I did just recently, right?
Yeah, let's do it.
Okay, so we'll go back to 2025 with APP. And this is a stock where it took off so darn fast that oh my God, it's right here. It's all the way back here. And God, is that possible?
It was just a perfect, tight base.
This is way better.
Yep.
So it had this huge run. And then it made this base. And dude, it went from 9 to 45, so up 450%. And it had triple digit sales and earnings. I barely understood what they did. And it just explodes out of here. And I tried to throw the book at it, but it moved so fast. I knew the price was 45. This splits adjusts when I go to the other, or wait, maybe I might have bought it right here.
Yeah, that's the base that you were talking about.
Okay.
Yeah.
This was a much nicer base. You had the shakeout, and then it came out of here so fast that I only think I got a 12% position on.
And then it just exploded.
And
Absolutely.
You said, how do you know it's the leader? I don't even know if they had competition, but look at the closes. It closed at the high. And look at this run. It has 10, 15 weeks, and it closed down 1, and it closed at the dead high that week. That's how you know you have a monster. This right here looks very much like some gaps I had in Baidu and RIM. Now it gets up in here, and I thought this was a climax. As a matter of fact, I think I can't remember if I sold it into this one or into this one. I think this one, right? God, I'm so bad. I probably sold it right here, and then I was fighting this. I didn't like this digestion at all, and I was stunned that it made a higher high. But let me see if I can get the earnings. So look at these numbers. Triple digit sales, triple digit. Well, the earnings are triple digit. How come I'm not? That's 24. So it really comes on with sales and earnings are exploding. The margins were great. 50% profit margins, 35%, 135% return on equity. Estimates were triple digit. At the time, I think management had more than 5%. Up to down volume was like 2.0. It was in like an elite group in the top 10 or 20. After-tax margins are 66%.
Insane.
I mean, when you see numbers like that, do you really need to understand what they do? Like to find out there's something amazing going on there? So I ended up blowing it all out into the highs, and I may have hedged once or twice into there. As a matter of fact, I'm pretty sure I might have hedged right in here. And I covered them in here and just let it go.
Because that was earnings and it gapped up. So you hedged before earnings? Or
I definitely. Now in that case, I bought a bear put spread
Mhm.
because I want that upside. So I don't even know what is it? Price is 80 to 410. Now again, some of the hedges might have diluted some of that, but I caught the bulk of that move. And then
And this is a stock that obviously was already in a longer uptrend. It had already, almost 5x off the lows.
Yes.
So you're buying high, but aiming to sell higher, basically.
I have to tell you, it had 3 weeks tight in here. This base, when you just go bar by bar,
Yep.
it was so much better than it looks right here. Like I was all through these weeks in here. Every week was in the Roppel report. When you see something like that with these kind of numbers, again, I'm a little stunned that these numbers they had to be up in here. Because I probably would have bought this even with the bad sales, but the base was so mouthwatering. It's like you just see it and you know the action.
Look at that shakeout bar, that shakeout week,
Yeah,
and then just rip to highs and then tight. I don't know if that's like a 2 weeks tight right at the highs before it actually took off, but the shakeout bar that week, huge. And Gev set up the same base at the same time right here. It's amazing. It's like the exact same pattern, and it ripped as well.
So they just keep coming.
Yep.
Like, and it's never going to stop because the human desire to get a piece of the pie, to innovate, humans want to climb. So they're going to get in their laboratories and coach and try to improve life, and their products are going to keep coming. You go back as far as the stock market's been open and you see bases like this, they just over and over, there's only so many that have the triple digit sales and earnings. And we're in this minute right now where I talked about where the commodity stocks don't have that. But like, if you catch one of these every 3 years, with 18% of your, now again, I didn't have the full 18. I didn't get the whole thing on. So let's look at, I was big on A-Lab back then.
Yep.
And I was like, it's an earnings, or ANET. I had ANET. I had A-Lab and ANET. This was last year. I'll do ANET first. I mean, I thought this was one of the most impressive stocks in look at these pre-tax, after-tax margins, return on equity. It was 99 comp, and the stability. Stability separates the flash in the pans. I really detest these quantum stocks. What's the symbol on one of these things?
There's
AR,
IONQ. Well, Oklo. There's
not Oklo.
Oh yeah,
IONQ. So these stocks are mostly like 50, 60, 70% off the highs. They have no earnings. With no earnings and 50% off the highs, how far away do you think quantum is? Like, the analysts don't think they're going to earn money as far as you can see. So anyway, look, there are no numbers here. So you go back to ANET, and even though the stock has been stumbling, back in here, this just trended beautifully. And it had, I know 20% is not triple digits, but look, Cisco went to Pluto with a decade of 20%. When you have fat margins like this. And again, so this is just a super high quality name. And I'm so bad with my memory. I don't know if I bought it here, or I probably bought it a bunch of times. And this was Tariff Mageddon.
Yep.
And I blew the whole position out in one block. Because I just felt the violence with which, I think I sat through this break. I really do. But when it broke this way, I just vomited the whole position up. No regard for taxes, just let it rip. And in spite of the fact that, I don't think Kramer has the greatest stock acumen, but he did have this saying. He goes, that stock was an incredible horse. He goes, but it's just a horse. Almost every single stock that I have been in or through history that's been a monster eventually was usurped by a new technology, and it went to zero. Almost all of them. So even though I might go, it's a 99 comp, 99 RS powerhouse with everything, it's just a horse. And in technology, life cycles are much shorter than it is with energy drinks. Like Hansen has been unbelievable.
Yep.
NVIDIA is an anomaly of anomalies. And Tesla, 3 climax runs. Like, I thought the first one was over. The fact that it has come around. You asked about management. Dude, he's George Eastman. Okay, he's Thomas Edison. I'm not fighting against this guy.
Yep.
So how about CRDO? Or we looked at CRDO. Now CRDO had, I think management owned some massive amount of this thing. My memory is just getting worse and worse. Management still owns 9%. But look at these numbers, triple digit monster. And I showed this in the report every single week. I must have bought it right here. And, pre-tax margins, return on equity, I said 20% across the board. Estimates, 366. Now here's another thing. They're supposed to grow earnings by 366% this year. Well, it looks like hard cable is being replaced by fiber. So I don't care if it has 42% estimates for next year. The relative strength, if you looked at a short-term RS, it would be low 20.
Yep.
So it's over. And I say the 50-day, or this is the 10-week, is the guardrail. Whether the index is below it or your brainchild gem of gems is below. Dude, I bought it right here. I had to have bought it right there.
Yep.
Now this is, see, I thought this was super erratic.
It's wider and loose for sure than the prior move.
So I was in it right here.
Yep.
And I saw that reversal and I thought, KAVA. KAVA,
Yep.
I did really well in.
Yep.
It just had this, when you see a earnings rejection like this, and what scared me recently with NVIDIA is when you have great news and the price doesn't go up, that's not good. And NVIDIA has now done that through 6 reports.
Mm-hmm.
So, look at these numbers, 1,200%.
Yep.
We
Show KAVA real quick just to show this move and the reversal if it's recent enough. Yeah,
right here.
Amazing IPO move into a climax. Insane.
Now, I don't know if I bought it right here or right here or right here. I bought it all 3. I can't remember. But I was so stubborn with this.
Mm-hmm.
Absolutely did not sell a share. And I ended up getting out of some of this bad break in my hedge fund. I dumped it all. I might have hedged it right here, but I definitely got out at this point. Now it's definitively making lower highs. And I mean, dude, if you just stayed in stocks that were 99 comp, 99 RS above the 50, you're shooting at the elite names. And I'll tell you, a lot of people, O'Neill has internal PMs. Almost every one of them who left failed because Bill put the stocks on what was called the NESMI, the new stock market ideas. They weren't allowed to buy the names off that list. So they're shooting in the target rich environment, and Bill set the exposure. So he would say, oh, everybody's got you have to raise exposure today 25%, or you have to reduce 50. So you've got the master of masters telling you, this is your list to buy on, and here's what your exposure is. The key is the accelerator after you've had the brakes in the accelerator after the run's ended.
Yep.
And he was great at it. Almost everyone who left him failed. No, there's been a few who've done really, really well, and I love talking to you guys. You know who you are, but most of them failed. So I don't know what I'm talking about. We talked about KAVA.
Yeah. You were going to bring up another stock. Was it? I forget which one.
B?
Yeah, maybe BE. Let's do that.
Okay, I didn't buy it there. I bought it over 40. I thought this was your pivot. So I loaded up. At one point, I had 300,000 shares of this thing.
Mm-hmm.
And I had hedged it a few times through here. And then when this occurred, I was in a hedging. I've been hedging like crazy through here. When it got over 120, right here, I hedged all through this. When it cracked above 120, I took it off. And then I've been forced in and out of hedges all the way through here. This big down move on last Thursday or Friday, I came into the market and sold calls against my whole position at about 1:30 Chicago time. And I think the market maker took it without a hedge on the other side. And the market started to roll over. And that guy who took my calls drove this thing down that hard.
So we can blame you for that?
Yeah, call the SEC. Totally legit trade. The other guys didn't hedge himself. But anyway, the personality is very much so changed in here. This is just as wide and loose as a goose.
Mm-hmm.
And I'm leaning into this fundamental story. But look at these numbers.
Yep.
They lost 10 cents in 23. They're expected to earn $1.40. I think they're going to earn substantially more. Now, the margins are coming around, but the after-tax is 29%. That's a flaw. I can overlook one flaw, but I can't overlook too many. But then let's go. So sales are sideways to, they're above 20, but they're erratic. The beat was 45%, even though it was only up 5%. I just look at the reaction. Next quarter, they're expected to have a 333% beat, or I'm sorry, growth. So, how many stocks do you need to buy at 40 that go to 150, 47? And I'm still in this thing. I think you show me a better solution for energy. Like, the world is being scoured. Every little rock is being turned over for energy. And I've had, I probably catch something that goes up 100 to 200 or 300% every 2 or 3 years. And I usually have a couple augmenters that are going to go up 40, 50% during the year. And the whole package, turns out good. But they're just never going to stop. They've never stopped since the day I opened up the first IBD and I saw the full page chart of like Mid-Atlantic Medical, right? And then it was Micro Touch Systems, and then it was Micron Technology. And I mean, there's just, every year you go through the paper, IBD has the top 100 stocks of every year, and almost every stock on it is up 100% or better. That's 100 pitches to have 100% gainer. And the top 10 are usually like 300, 400%. Like, it just doesn't stop. So I'm a bull. I'm a total bull, man. We getting pizza?
Soon. I got a little bit more from you, Jim. So I wanted to talk about O'Neill, because obviously he's had such a huge impact on probably everybody who watches the podcast, and of course you. Talk to me about how you built that relationship and got closer with him, and maybe some of the key lessons that you learned early on from him that made the difference.
I want to draw a parallel about how to get there. There's this guy named Josh Darwin, and he kept calling me and saying, hey, what's going on? And one day, so I have all these porcelain skulls. They're Mexican skulls. And he goes, I have a gift for you. I'm like, well, you don't have to do that. It's very neat. He goes, no, I'm coming to Chicago. I'm going to give it to you. Comes into my office with a porcelain skull full of tequila, high-grade tequila. I'm like, I love this kid. Now so he got in my circle, and he brings things of value to me. I say, hey, I need this. So you need to get a mentor. Now, how do you get next to Stan Druckenmiller? I am no Stan Druckenmiller. I'm just a dude. I'd polish his shoes. Bill, I didn't know he liked me, but one day he drags me out of the audience and hands me the microphone and goes, tell him what you did. And so from then on, I was not a customer. I called Lee Freestone. Then I started to talk to Bill a little bit, and I would always talk to him but I sat in the first row. Now, you see somebody in the first row 20 times over 5 years, you go, well, this kid cares, right? This kid drives to the paper depot every single night to get the next day's paper. So he paid attention to me, and I got to talk to him a little bit on the phone. And then when I became an institutional customer, he had to call me and he had to be nice to me. And I didn't bother him. I learned not to ask stupid questions because he had no patience for, like, if you didn't know Webster would go, if you brought him a stock that had no institutional sponsorship, I think he would, I don't want to overstate this, but like, be prepared for 30-minute ass chewing. Like, so you stop doing stupid things, like you touching a hot burner. And having Bill write down personal notes on stocks that I screwed up, and then he would call me on follow-through days. He'd say, what'd you buy? And I wrote this in the report last week. I said, well, I didn't buy anything. He's like, if I was an employee, I think the ass chewing was on its way, but he just was disappointed. He's like, well, you have to buy something. And knowing that he always was in, not a leader, the single best leader, and it was generally a liquid name. Dude, one time I went to see him when he was campaigning for Dole. Robert Dole, and he went to stuff for him in Iowa. So we flew to Iowa, Cubby Bears and I. And I'm in the airport, And Bill's sitting in the terminal with security. And I start walking up, and this guy's like, you can't talk, stay away from that man. And Bill's like, come here. And I sat down next to him. We waited for a plane, and I took notes by hand for 2 hours.
Wow.
I did it on an iPad. And he just, I think when you talk to somebody who has a lot of knowledge and you give them information and you work really hard, Bill wanted to help people.
Yeah.
I learned everything from Bill, every single thing. But I read all the books. I came up with legit questions. It's so funny. Like at the end of Bill speaking, there'd be like 10 people around the podium or 20, and they're the same questions I get on the Roppel report. They're the exact same questions. So ask me more. I'll try to answer better.
What do you think he understood about finding and managing model book stocks, market leaders that most people never get to? What do you think was his edge in finding and managing those?
Bill was buying the best merchandise. Most people will buy anything that resembles a cup and handle, and they don't even know it's flawed. They don't understand that CLS had slightly lower ROE or pre-tax than the other guys. Like, people don't put the time in to really, really discern what the magic elixir name is. What's the best liquidity with earnings? What's the product? Like, and Bill also had a team of analysts. He'd go, hey, go figure out what these guys are doing and come and tell me what's up.
Yep.
But what I found is if you don't do your own research, you don't understand it well enough. But Bill was in the best merchandise. I'm repeating myself, but he knew what the liquid leader was. He knew when to back off. He was also, now I'm mocking or maligning frenetic traders. Bill traded a lot. Bill would
added so much. If you look at his charts too, he's adding little pivots, all those points.
So I had another edge when I had a soft dollar account. So I ran lots of trades to them. So I asked for Bill's trader. So I always knew it wasn't supposed to tell me what Bill was doing, but I knew what Bill was. One time I'm buying Crocs and I hear him kind of like squabbling in the back, and I go, what's up? He's like, Bill's right here. He's buying Crocs too, and you blew him off the box, because they had to fill my orders first. So I had a lot of insight, not just talking to him, but I had frequently knew exactly what he was buying or selling at the minute. And I found that he probed, let's just assume he was a very wealthy man. He'd buy 500 shares and he'd buy another 500 and he'd buy 500 more. And like, he probed things a lot more than I do.
Yeah.
I'm a lot more of like a Lee Free. I learned a lot from Lee Freestone, where I'm a position sitter, where Bill was more active around the name. Like Eve diagnosed my Baidu trade. Do you know this? And I didn't even know. I made $30 million on it.
Yep.
I didn't know that, for one. And then she put on a chart where I bought it and sold it. I'm like, oh my God, I traded around this thing. Like, I didn't realize I was doing that. But I've slowed way down. I'm a lot more Bob Furman. I'm a lot more Lee Freestone. And there's implementation. There's nuances that I've adapted to my personality and my level of pressure that I'm going to deal with. But I do find that I slip into the cowboy in the heated up markets. Dude, I think Bill's ability to back off quickly. And another thing is, he levered up. He was a heavy margin user, but he didn't have to report to partners. He was solo operation. So if he drew down, which he probably didn't that much, it didn't matter. It was his money. But that unique ability to get really, really big, really quick, like they have a market school thing that Webster and Charles did. I think Bill was more aggressive than that. And Bill just persisted as a cowboy into his later 8 years. But then I had dinner with him one time, and he's like, I took every profit this year up 20% because that's all the market was given. So he knew when to dial it up and that's the Achilles heel of so many. I've said it before. Most people will do well in a bull. And the bear comes and they keep the accelerator down to the floor, and Bill's been gone forever. And that's another thing. I did know what Bill was in, but I didn't want to know, because I wouldn't sometimes talk to Bill for 2 or 3 months.
Yeah.
And he'd say, well, he was big on targets. And we'd be in the same stock, and he'd go, my target is this with the PE expansion, and that's 200 points higher. And we'd hang up the phone, and it'd have a bad week 3 weeks later, and he'd be out, and I'd be like, well, Bill said 300 points higher. It's actually detrimental to know that. Somebody that you really look up to, that's in your head.
Right.
That's why I have no TV in my office. I don't want to know. Like, you ran out of the room for a minute. I go, something happened. Get in here. You go, what happened? I go, I don't know. I don't have a tool. I don't have so knowing somebody that you really look up to, what they think is detrimental. Knowing it for yourself. And that's a problem because people want a tip sheet.
Mm-hmm.
They want people. So I heard somebody say one time, somebody will research buying a $200 microwave more than they will invest their $1 million pension or their IRA. What is up with that?
Yep.
People don't want to do the work. And straight up, let's tell you this. I was a retail broker for a long, long time, 20 years maybe. Brokers would leave and I'd get their book of business and the customers lost money. Most of them. And I think the same is true for people who are trying to do individual stocks now because they won't put the work in. They don't know what they own. They think they're in a proper base and it's not proper. Or they'll buy something that looks pretty good, but they don't know it's not the leader. Now, again, I will sometimes buy second best because I missed first, right, but I'm aiming to get that money into best when it does some type of digestion.
Looking back at the past 5 or so years, what do you think, what stocks you think Bill would have been, I've heard stories about him 200% long in one name at one time, obviously he has to get to that point, but what do you think, which stocks do you think he would have killed over the past 5 years?
NVIDIA for sure, at different times. I think CRDO, ANET, the names I looked at, I think BE might have been too volatile for him. Like it's too volatile for me. I don't know if I'd be in that name if I knew what I was getting into.
Yeah.
Man, you're killing me now, dude. Like, VRT.
VRT.
Lilly. Lilly, I can't imagine he wouldn't have been in there. Some of the semiconductor, like maybe a clack. I think, man, you're really killing me right now because I should know this. I'd have to go through the list. Are we going to do a little more taping tomorrow?
Yeah.
I'll try to come up with some names.
Cool. And do you ever ask yourself that question? What would Bill
all the time
now?
What would Bill do?
Yeah.
So I used to be like, I'm going to call Bill. And I go, I know what he'll say. I mean, you just know what he's going to say.
Yep.
But I don't think people refine the process down. What would Bill do is a great answer because you won't do. If you understood Bill's temper and what he expected from you when you pitched him an idea, you wouldn't buy half the stocks you buy if you had to run them by Bill. Mm-hmm. People buy all kinds of stuff all the time. They just want to be in the market. They want the action. They're there for the wrong reasons. I think another like, what would Bill do? Would you buy the stock if you had to pitch it to Bill? If you could only make 4 initial trades in a year, only 4. Well, you wouldn't buy unless it was immediately after follow-through day. You wouldn't buy unless it was an absolutely perfect name. You only get 4. If you think about it, I mean, that's kind of almost a reasonable standard.
Yeah.
I'm only going to allow myself to enter 10 names a year, and I'm going to get stopped out of 6 or 7, and 3 of them I'm going to clean up on.
Right.
Like, did I really need to buy that stock with a 2% return on equity? That the base is a little flawed? Like, no. People want to be active. They want action. They think it's a casino.
One question I want to ask you is, and I'm not sure if one will immediately come to mind, so feel free to take a moment. Is there a conversation you had with Bill or something he said to you that you remember every single day? Or you might find, you might think that traders watching this, God, it changed something for you, made you think about the market in a completely different way. I know it's probably hard to distill it down to one conversation as well, but yeah, anything come to mind about the most impactful conversation that you had with him?
Well, there's dozens, but one that kind of stung was at the Ronald Reagan Library. Afterwards, we're talking, and I said, I think I said, I'm up 300% this year. And he goes, well, we all put our pants on one leg at a time. He was extremely humble.
Yeah.
Like, humility. I know when I'm out at a restaurant or a bar and someone goes, hey, starts telling me how their stock market, they're great. And I just look at him and I'm like, this guy's either he's lying to me or he's about to lose all his money. I think part of the reason Bill kept his money is he was really, really humble, and he was doing it for the right reasons. He was doing it altruistically to help society,
right?
To defeat communism, to champion free markets, and to teach people how to change their lives.
Yep.
He wasn't trying to impress chicks or buy Ferraris or make it rain with $100 bills like Floyd Mayweather.
Yep.
I think being grounded. So when he said to me, yeah, well, we all put our pants on one leg at a time, he kind of knocked me down a little bit.
Yeah.
Because dude, how long ago was that? Dude, there were so many things. The triple digit sales and earnings, the liquidity, the selectivity.
Mm-hmm.
I would suggest most people that are listening to this have bought over half the stocks they bought in the last 12 months were stocks they should have never bought at all for any reason. Like, I looked at it one year. I had a bad year in 2022 maybe. And I went back and I only bought 23 different open new positions. I'm trying to do what I preach, but I don't always. That's for darn sure. I'm a hypocrite. But all the time I'm like, it has no earnings. There's no chance I'm buying it. But then when I find it and it has no earnings, I'm like, well, they're going to have earnings. Like, I'll bend the curve. Even I bend the rules. Like, when you have kids, someday you're going to get married. Hope you have kids. Your daughter's going to I want to have a sleepover on a Wednesday night. We have no Wednesday night, zero defect policy. Well, you can let them do it once a year. You can bend the rules like I did with that stock that had a lower ROE. One variable. But when you start making every trade a special occasion, you've lost your discipline. Bill.
Yep.
Dude, he's just the man. Dude, everything he said to me was like important.
100 years from now, what do you think are the most important principles that he preached and he shared that traders will remember and continue to, resonate with?
He has the 10 variables, like, keep learning.
Mm-hmm.
He preached modesty in spending. Like, he talked about life and outside of trading. But I just think, oh my God, I don't think, look, the number one principle is just cut your losses. If you can just get that down,
yep.
Like, imagine if you cut every single loss forever at 5%. Dude, just doing that. The people who are blowing up are not doing that. That's principle one.
Yep.
That should be the first thing.
Yep.
I mean, the evolution of a trader, cut your losses immediately. Stop over trading. Improve your selection criteria.
Yep.
I didn't say pivot point. I didn't even say base. If you just got those things down, selectivity. I think Bill never said it to me, but you can be rest assured every single stock he talked about was elite, not fourth best, not fourth sector.
Yeah, and I think it's Mike Webster's rules that first rule, cut your losses. Second rule, see rule number one, like so important. Jim, this has been awesome. It's so cool to get to talk to you face to face. Just two wrap-up questions for you that I think will cap things off in a really nice way. First, if you had to learn to trade from the beginning today, you're starting over with a 50K account, a 100K account, whatever it is, what resources would you use and how would you change the strategy that you're using right now, or if you would, right?
I'd get IBD.
Mm-hmm.
I'd read Bill's. Dude, it's so basic. This is so simple. It's not complicated.
Yep.
Get these books, read them. I would not get any other books. You do not need more than these. There's a couple others, like every Market Wizards book. I don't like hedge fund Market Wizards that well. I would learn money management immediately, which I didn't know money management for 20 years.
What does that mean, money management?
Position sizing.
Okay.
Risk management is not just cutting your losses, it's position sizing.
Yeah, because they go hand in hand, right?
Yeah. You can have, it's very important. And knowing yourself, like you got to understand, if you could understand yourself before you start losing money or learning from the market, that's going to help. Not deviating, like it's the cross-pollination of different methods, like putting GARP into CanSlim with whatever these other, there's probably like 20 legit ways to make money in the market. When you start cross-pollinating them, I'm a total purist. Like the O'Neill rep would come see me and he'd go, God, he goes, he goes, all the people I cover, he's like, you are total, I'm a knockoff artist, dude. The Japanese, they got it right. Get the product, break it down and copy the thing. If you're half as successful as Bill, you're worth $500 million. Get a mentor. Don't deviate. Don't wander into 30 other books. You just need these books and you reread them over and over. I can quote most pages of How to Make Money in Stocks. I know it that well. I've read it 30 times. Go see Richard Moldman, man. That's the boy. That's the man. Thank you so much. I really enjoyed it. It was, and doing this, like we've done several on Zoom. It's a whole nother world when you're disconnected when you're on a screen. It's way better in person. I didn't realize this.
It's so much fun. And I've got one more.
Okay,
one more. And it's a little bit what you just said, but what general advice do you have for traders watching this to help them achieve their potential, reach for those triple-digit returns when the market is set up for it, right? After a significant correction, bear market, what have you. Maybe a trader who's in their first few years, they've started learning CanSlim. This could be advice. This could be words of motivation, which, you're the man for. What would you say to them?
So in Marty Schwartz's book, Pitbull Trader, not a lot of insight on trading methods. Like he's got some magic tea and whatever, but what he had was this ability to identify the possibilities that this might be a stock that could really go up 500%. My really close friend, Dr. Paul, I gave him the book and I said, to a man who has vision, because when we were buying CME, when it just came public, he's like, I think this could be a $500 stock. I'm like, $500 stock? He had vision for the possibilities because he's an optimist. Be an optimist. Get it. Look, it's impossible to be a pessimist and say something like this $50 stock could be a $500. Have an idea of the potential possibilities of what it can do. Study the past TMLs because it's going to give you an idea of what a real monster can do.
Right.
Now, again, I say take life-changing money. Like I needed a timing chain for my car, a Honda Act Legend. It was $1,500 and I had this stock called Macro Media and it went up like $2,000. I took it because had I lost it $2,000, it would have been Macro Media. Had I kept it, would have made 10 grand or 50 grand. Knowing what's possible. And then along the lines, take money that's life-changing. But after you make 50 grand a couple times, 50 doesn't matter anymore. Now it's 100. You make 100 a couple times. And the ladder just keeps going up. Know the possibilities, and only someone who's an optimist can come up with bullish possibilities. Be a bull. Bulls win. We're more fun. Way more fun than those cranky dudes. Dude, I don't know.
That's good. That's good. And the very last question, I lied. Somebody wanted to ask you from X, is the golden goose of capitalism still alive today? Will it be there in 10 years, 15 years, 50 years?
That's what the freedom and free market index. We need to find the meter, like the pessimism bull index. We need the world socialism free market index. I think that unless you kill the indomitable human spirit to excel, to get your piece of the pie, to innovate, to lever up, to be better in everything, unless you kill that, you're not, the golden goose is never stopping. There's going to be more Elon Musk. There's going to be more brilliant people. Yes, absolutely. It's going to be better. The golden goose is totally chill. He's in my garage. We're feeding him a lot of vegetables, vitamins.
He's getting ready.
We're doing wing stretches, like curls. We're getting him bulked up. We're getting some rockets we're going to put on him. And I suspect that we'll be fueling up soon for big flight.
Perfect. Well, Jim, thank you so much, man. We'll leave it there. Really appreciate you.
Oh, hold on. Go ahead. Speaking of the goose.
Oh, yeah. Where can people learn more from you if they'd like?
Roppelreport.com. If you want to subscribe, you can use the code Goose for some big discount that my wife has told me to tell you can get. Buy the bundle. And golden? Did I say goose?
You say goose.
Golden. Golden, not goose. Oh my God. And I'm on X. I tweet on X occasionally. And by the way, they're programmatic. So like I'll do a bunch of videos with my daughter, and then she'll put them in a program and they'll come out. Well, the ones that come out 5 and 7 days later have stale information. And I got these hecklers. Here, you want a better life? Ignore those hecklers on X.
There you go. That's the final advice we'll leave it with. Jim, thank you so much.
Hit it, big dog.
Yeah, cheers. To everybody watching, make sure you leave a like down below, subscribe if you're new to the channel, and we'll see you in the next one. Cheers, everybody. Take care.